This Monday morning, welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know this morning.
Hey, good morning, everyone. First up, Wall Street is awaiting the Fed's final rate decision of the year. 97% probability here of a 25 basis point cut at the central bank's two-day policy meeting. This is according to the CME FedWatch tool. But with recent data showing a solid U.S. economy, a healthy, cooling labor market, and sticky inflation in some areas, many expect that the Fed will cut less than initially thought in 2025. Investors will also focus on the Fed's economic projections and what the Fed chair, Jerome Powell, says about the pathway forward during his news conference, 2:30 p.m. Eastern Time, Wednesday.
Plus, Bitcoin rallying once again, crossing 106,000 for the first time ever early this morning. The Trump-fueled crypto rally has certainly pushed Bitcoin up. It's up around 50% since the election. The inclusion of MicroStrategy in the Nasdaq 100, well, that has fueled some of the optimism this morning. The company is the largest corporate holder of Bitcoin, and it keeps buying more by selling shares and convertible bonds. MicroStrategy Executive Chairman Michael Saylor, he recently told Yahoo Finance that he'll be buying Bitcoin at the top forever.
Wow. And stock futures are higher to kick off the last full trading week of the year here. It comes after a sluggish week for stocks. The Nasdaq outperformed, bolstered by a reversion to more tech names here. Now, market breadth, it appears to be narrowing once again in favor of the biggest names in tech. The Mag 7 outperforming the broader S&P 500 over the last month. Stock futures ticking higher after a sluggish week, but one asset rally is fueling Wall Street this morning, and it's Bitcoin, rising to yet another record, breaking above 106,000 earlier today. Currently, right now, you're seeing it trade just below 104,000. The Trump-fueled crypto rally has certainly pushed Bitcoin up around 50% since the election, as you started to get clarity around some of the picks for key positions in his cabinet and also on commissions that would have more of a crypto-friendly stance. And also, I would add to this as well, you're seeing even more likelihood that we'll see some of the institutions, some of the largest firms with assets under management start to recommend a positioning to their clients and an exposure that is going to be markedly higher than what we had heard previously. Even BlackRock here seems like they're eyeing a 2% Bitcoin allocation, recommending that to clients is a major move, especially for some of the biggest wealth managers out there right now. And if we see that anywhere between a range of 2% to 5% compared to the previous 60-40% allocation that we had heard previously from a lot of these firms, that's significant for cryptocurrency as a whole and much more so for Bitcoin here too.
Yeah, I think it's just an unrelenting move to the upside has certainly caught Wall Street's attention. Obviously, when you take a look at the price, now here we are right around 106,000. A lot of this, I think the question is how much of the optimism is already baked into the prices right now. We certainly are betting on the fact that Trump is going to be a very crypto-friendly administration here going forward over the next few years, not to even mention the fact that he is once again backing this idea of a strategic national Bitcoin stockpile, although many are still questioning how feasible that proposal is. So there's lots of questions just about how realistic some of these aspirations are here from the incoming Trump administration. But when you take a look at the price right now of Bitcoin, it's up 7 weeks in a row, the longest run that we have seen since 2021. It's exceeding that previous peak that we saw back earlier this month. And you take a look at the move to the upside, some excitement surrounding MicroStrategy, which has very much been one of the big bets that investors have been making, announcing for the 7th Monday in a row, I believe, quite a few Mondays in a row, that it bought another $1.5 billion of Bitcoin in the past week. Just shows how much that strategy is, one, paying off for now, but two, just what that means in terms of 6 Monday in a row that they did announce that they were buying more Bitcoin. But again, that just shows how much belief some people on the street have in Bitcoin right now. And when you take a look at that interest coupled with what we're hearing from the incoming Trump administration, that, of course, and you could say that it's expected to further fuel that rally. I think the question is how much higher it's going to go.
Absolutely.
All right, well, futures pointing to a higher open as the Dow looks to snap a 7-day losing streak. But the biggest moves in the last week were mostly in the Mag 7 as the bet on a broadening rally has taken a U-turn. Joining us now, we want to bring in Michael Reinking. He is a New York Stock Exchange NYSE senior market strategist. Michael, it's great to have you here on set. So negative breath is certainly dominating the conversation over the last several trading days, the last couple of weeks. How worrisome is this worrisome at all for the broader market?
Well, first and foremost, thanks for having me in. Look, I think what we'd seen kind of post-election, right? We saw that real strong breadth expansion, in the immediacy following, kind of following the election results, and then now we've seen kind of the mega cap tech stocks start to come back as of last week. I think what we've seen in terms of that equal weight S&P 500, we've pulled back right into kind of some key technical levels, right around the 50-day moving average. It's about a 50% retracement of the post-election move, right? So we're at kind of an area where you'd like to see that breadth expansion start to kind of pick back up. And I think what part of what that has caused that is kind of the higher inflation numbers that we've seen, some expectations that we're going to see some less rate cuts, heading into next year.
Where is the breadth expansion from here, you believe? Which sectors are most ripe to really see that and be a beneficiary?
Yeah, I think it's, I think the financials, right, are an area that people are looking for some kind of strong performance. Industrials as well, right? I mean, as you kind of see the reshoring, and kind of the focus on kind of economic expansion here, and the financials will benefit from kind of the regulatory environment, kind of the improvement in the regulatory environment. It's been very interesting that over the last couple of weeks, we've started to hear, some more rumors of potential takeovers. We're starting to see kind of the idea that corporate America is expecting the regulatory environment to be better as we head forward.
Michael, I want to pull up a chart here comparing the S&P equal weight to the Nasdaq, and some of the outperformance is really highlighted in this chart from some of these tech names and exactly what we have seen. The Nasdaq is obviously the blue line there on the screen, which has outperformed here over the last several weeks. When you talk about the fact that we are maybe potentially going to see this broadening once again, I think the question is, what exactly is going to be that catalyst, and how long is it going to take in order for that catalyst to come into play?
I think it's really a prove it story, right? So it's the idea of kind of earnings growth going forward. We've seen the mega cap tech stocks, right? Their earnings growth rates have far exceeded the equal weight version of the S&P 500 over the last couple of years. That gap is expected to narrow this year, right? So you're looking at kind of the Mag 7 going from something close to 50% year-over-year earnings growth rates to about 20%, but we're expecting to now see that equal weight, kind of start to perform. And people have kind of been burned by this rotation multiple times over the last couple of years. We've had a couple of fits and starts where it hasn't necessarily panned out. So it's going to be a situation where you're going to need to see companies, being able to kind of meet their earnings expectations, but you want to see kind of some, the earnings revisions start to move more positively for that equal weight, kind of contingent.
I was looking at some data from S&P Dow Jones indices, and they said after declining in 2023, companies have increased their buyback expenditure and have remained in dollar range for the first 3 quarters of 2024. I bring that up because what is the likelihood here that investors may see a combination of both earnings growth revisions to the upside at the same time that they see some new buyback programs initiated from companies next year, as you do have an incoming administration that certainly has kind of rolled out the red carpet for buybacks in the past?
Yes, yeah, and look, I think the expectation is that buybacks are going to continue, right? That unfortunately, those buybacks are very concentrated at the top end, just like everything else at this point, and that's also helping to fuel kind of some of the earnings growth, at that top end. And they make up, I forget the, kind of forget the percentages, but it's a very big percentage of the kind of the overall S&P 500, buybacks. We have seen, kind of companies coming back to the, reinstituting buybacks. I'd expect financials to continue to do that, particularly as they get a better sense of what Basel III it looks like as we go forward.
Michael, when we talk about some of the action that we've seen play out in the market, we led off with Bitcoin and the rally that we've seen above 106,000. I'm curious just what the talk has been on the floor about some of that euphoria surrounding crypto, and how much of that, when you talk about what we could potentially see under a Trump administration, how much of that has already been priced in right now?
Yeah, and I mean, my focus is primarily on equity markets, right? I think there is clearly some optimism in terms of what the administration is looking to do with cryptocurrencies. In terms of Bitcoin particularly, right? We've seen kind of this institutionalization of that cryptocurrency with ETFs and things of that nature. Right? I think there's still some more room to run. I think as you get to these big round numbers like 100,000, right? You go into periods where you're going to see some consolidation. I think that's kind of where we're at. Right now, we've had such a big move over the last year. Technically, we've been pretty positive positive. And I think you're going to see some consolidation in and around these levels, and you've seen kind of even on that first burst above 100,000 where we pulled back to 92,000. That pullback was very, very short-lived, and we're once again kind of right back above 100,000. So I think as we kind of consolidate here for a little bit, that and we get a better sense of where policy is going, then you can continue to see some.
So traders will wear Dow 45,000 hats on the floor, but they're not going to wear a Bitcoin BTC 100,000 hat. Michael, come on now. All right, Mike, appreciate the time this morning.
Thanks, guys.
Great to see you. Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's talk a little MicroStrategy, Palantir, and Axon. They're all set to join the Nasdaq 100 next week, replacing Illumina, Supermicro Computer, and Moderna. The inclusion will take effect before the market opens on December 23rd. You're seeing how the stocks of each of those companies are moving here, pre-market here. This is noteworthy, especially for the fact that the Nasdaq 100 as its own ETF or index play for so many investors out there, this just gives those companies even more exposure into portfolios as well.
It does, and Brad, you're certainly right. When you talk about just the significance of this, why there is so much emphasis placed on a change like this, a changing of the guards, if you will. Obviously, it's that exposure here to funds and the broader market and what exactly that means here for investors going forward. What stuck out to me is the inclusion of MicroStrategy. We talked a lot this morning about the euphoria and excitement surrounding Bitcoin. Obviously, when you tie MicroStrategy, that's one of the first things you think of, just given how big of a buyer Michael Saylor and his team have been of Bitcoin here over the last several weeks, to say the least. And then when you go back over the last several months, just in terms of the shift of the strategy for Bitcoin. And then you have MicroStrategy coming out this morning saying that it actually bought 15,000 more Bitcoin for about $1.5 billion in cash. So that's fueling some of that optimism out this morning. But more broadly speaking, when you talk about the inclusion of not only MicroStrategy, but also when you talk about Palantir and Axon, it's obviously the inclusion of some of these funds and what that means more broadly speaking about ownership here and some of the movement, some of the momentum that will likely add to some of these stocks here in the coming weeks and months.
Absolutely.
All right, next let's take a look at Apple reportedly planning some major product design changes to help boost growth. The company is expected to introduce a thinner iPhone next year that's going to be cheaper than the current Pro models, with a simplified camera system that's being done in order to keep the cost down a little bit. The company is also planning 2 foldable devices. One will be a laptop, the other will be an iPhone. So a lot to unpack here. This would be a major design and format change here coming for Apple. I think the question is what exactly the appetite and need and want is going to be of that foldable side of the equation, and something that's been rumored for quite some time now. Our Yahoo Finance tech reporter, Jan Halley, has been reporting on this over the last several quarters. But I think it's evident that Apple might be under a bit of pressure, to say the least, just in terms of their innovation, the pipeline, and what needs to happen. Lots of talk about whether or not the inclusion of AI and what we were seeing in the iPhone 16, whether or not that's going to be enough to really boost demand here for devices. Obviously, this current quarter here, the holiday quarter, will give us a much better idea of that. But a thinner phone, that to me makes sense, especially with the cheaper price tag.
Just so I can crack my screen quicker? Great. Love it.
I don't know.
Foldable devices also notably have not been sold on them in the past. However, there is growing appetite for that. And Apple necessarily has looked at the market historically here. Tim Cook, especially in his operational mindset, has always assessed the landscape, seen what the market is actually demanding and consumers are really navigating themselves and gravitating towards, and then decided, okay, how do we leverage our ecosystem, our existing install base of a family of products, and then come out with a product that has a superior experience or just further entrenches themselves to say, okay, well, if I want to stay within the ecosystem and make sure that all my devices are interconnected, then obviously I need to just opt into this new device, whatever that is, whether it be thinner or sleeker or faster or foldier. All of those things considered, I think Apple, that's how they've maintained a lot of their fanfare for years, is the stickiness of the ecosystem and the existing install base. But what might be interesting now is I think consumers are coming around to the nerdiness of what they need to know about their devices, whether it's chips that are being talked about. Well, we spent much of last week talking about this new quantum computing chip. We did a reader on it and everything. Kathleen wrote it up, and we sat there and we're like, well, Google, they might be, Alphabet might be onto something here. Yeah. And that made it into our social media feeds. Right. Now you have everyday people talking about what this chip is going to do. And we have no idea what quantum computing is, but it's got the mind share of everybody who's out there thinking about, okay, so what does this mean for all of the devices now? Are my devices going to be smarter? Am I going to be able to be smarter because my device is smart? All of these things cascade down and then eventually make it into the purchase decisions as well here. On top of, is the camera going to be good?
Yeah, and I think the question is how quickly that is going to factor into the purchase decision, right? Just in terms of how much of it has to be a show me story in order for people to fork over more money or in order to fork over money just in general, in order to get that. I think they need to see what that payback is and what the boost is going to be. Because I think that's also being really felt with Apple's new iPhone lineup and kind of the lackluster demand that was initially reported on there heading into the holidays.
Smarter phones, longer battery life, and make me smarter too.
And a good camera.
And a good camera. That's what you need. Finally here, Honeywell, exploring a separation of its aerospace business as it continues evaluating its business portfolio. This comes after activist investor Elliott Management called for a split of the company's aerospace and automation businesses after taking a more than $5 billion stake in the company last month. Honeywell plans to give an update on its portfolio review when it reports fourth quarter results early next year. You're taking a look at shares. They are seemingly relieved here, pre-market up by about 2% here. And the aerospace division certainly is a costly one for Honeywell and for the investment management side and the activist campaigns that came forward from Elliott really focused in on how do you alleviate some of that pressure as well, knowing how much it costs to really operate those divisions. We've seen that at GE before. We've seen that at several other businesses that have an aerospace division and then have to figure out, okay, how do we make sure that we're alleviating some of the margin pressure that exists?
Yeah, exactly. And I was at the Materials and Industrials, Goldman Sachs' Materials and Industrials Conference just a few weeks ago, earlier this month, and that was very much the focus, or one of my big takeaways from the conference was just how much more focused so many of these larger corporations are getting. And we've seen those efforts from some of the others within the space when you take a look at 3M and what they have done under their new CEO and how much of that turnaround is already starting to take shape and how optimistic the street is about what that outlook looks like. You mentioned GE, obviously one of those names that has done that in the past. So I think taking a look at Honeywell, the fact that they are exploring all strategic options, the street very encouraged by that. When you take a look at the last year performance, they've been far underperforming the S&P 500. So again, we are seeing some optimism play out here this morning when you take a look at that pre-market action. I also thought that Elliott's response here was interesting, saying that the portfolio transformation that Honeywell and their team are leading represents the right course for Honeywell. So very much was what they wanted to see potentially here going forward. I think the question now is execution and how exactly that all plays out and how big of a boost it's ultimately going to be to their bottom lines.
They listen to us. They're doing the right thing.
They like it for now. But that's also important to point out just in terms of how effective Elliott typically is when they enter the conversation and some of the changes that they are able to enforce upon these larger corporations. All right, coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, at 10 a.m. Eastern Time on Catalyst, we are setting you up for a new year and a new administration. We will be doing a deep dive on the impact of President-elect Trump on a number of sectors, including chips, manufacturing, big tech, China, and the housing market. Yahoo Finance has named its 2024 Company of the Year. It's Walmart. After 4 quarters of record earnings and a 77% run so far this year, it took the belt over NVIDIA, General Motors, Palantir, and more. We'll discuss more with Yahoo Finance's executive editor, Brian Sazzi. He's joining us in the next hour. We got that and much more coming up on Morning Brief.
One of the biggest stories for the market this week is the Federal Reserve's policy decision of the year, final one here. Now, markets are pricing in a near 100% chance of a 25 basis point cut at the meeting. Here with what we can expect in 2025 is our very own Jennifer Schonberger. Hey, Jennifer.
Good morning, Brad. That's right. Investors on Wall Street betting that a 25 basis point rate cut this Wednesday is basically a sure bet. But the bigger question is whether Fed officials could scale back the number of rate cuts projected for 2025. Back in September, Fed officials forecast 4 rate cuts for next year, but that's now in question after the job market hasn't shown new signs of weakness and inflation has remained in a sideways holding pattern this fall. Some Fed officials also expect the policies of the new Trump administration to create even more challenges for central bank policymakers. Fed Chair Jay Powell has left enough breathing room for the Fed to adopt a slower pace if needed, saying earlier this month that, quote, we can afford to be a little more cautious because the economy has been stronger than expected. Former Cleveland Fed President Loretta Mester is one who believes officials will scale back the number of rate cuts to 2 or 3. EY Chief Economist Greg Dacco and Deutsche Bank's U.S. Chief Economist Matt Luzetti also see 3 cuts next year. But others like Morgan Stanley and Luke Tilley, Chief Economist for Wilmington Trust, think the median projection will remain at 4 rate cuts. Tilley notes that it would take many more for the median to move up to fewer than 4 cuts next year. Fed Chair Jay Powell likely to maintain a cautious stance on Wednesday during his press conference, probably saying that the Fed is not in a rush to lower rates. Guys?
All right, Jen, thanks so much for breaking that down. I want to turn to that all-important rate decision. Markets pricing in a 25 basis point cut on Wednesday. That's the 3rd consecutive cut of the cycle. But our next guest thinking that the Fed is going to potentially take it slower in 2025. Stephanie Roth, a chief economist at Wolfe Research, joining us here. And Stephanie, we just heard Jen's great report just on where things stand right now in terms of some of those expectations. It sounds like here that you share in the belief that we are going to see a slower pace here from the Fed in 2025. I guess to what extent, what then does that slower pace look like?
Yeah, so our base case is, of course, they cut this week. That's largely baked in. And then looking ahead to next year, we think they'll cut three times, or at least we think the Fed will put that into their dots. We actually think they'll cut one last time than that. And then they'll ultimately have a longer run dot of 3.1%. And then eventually get down to 2.9. So base case is that they're going to slow down their pace. Why? Because the economy is doing fairly well. We're looking at almost 3% GDP growth for this year. Next year, it should slow down notably, but still run above trend. And in that environment with slightly sticky inflation, it's going to be hard for the Fed to continue at this type of pace. So it very much makes sense for them to slow down. And again, we think that they'll project 3 cuts, but we actually think that they'll only do 2.
Okay, so with all that in mind, how are you kind of anticipating the dual mandate to really kind of move through and kind of the best estimation of where we'll be on the inflation front and then on the employment front next year?
Yeah, so we think that there'll still be a decent balance for that, but both things are going to be running fairly firm. So the employment backdrop should be okay. We're actually expecting the unemployment rate to tick down from 4.2 to 4.1 next year. Big reason is immigration trends will likely slow down pretty substantially. And then on top of that, you'll have inflation that's sticky around 2.3%. So I would say both sides of the mandate, and inflation and employment, should be running just fine, but not consistent with the Fed cutting at a quarterly pace or anything quite as significant like that, or even at a by meeting basis, which is what we've seen since September.
So, Stephanie, your projections, it sounds like contradict some of the, warning signs that we've gotten from other economists saying that we actually could see inflation reaccelerate next year as a result of some of the policies that we could see from the Trump administration. Why aren't you that concerned or able at least to look past maybe some of those concerns just in terms of the fact that you are so confident that we are going to see at least eventually some continued improvement in inflation?
Yeah, so we're looking for that 2.3 pace in core PCE. So that still is above the Fed's target, which is one reason why the Fed does have to slow down the pace. That said, it's still not anything that's 2.5 or even 3%. A big reason is that the economy has downshifted from an inflation perspective. Wage growth is running at somewhere between 3.5% to 4%, which is consistent with close to 2% inflation. So in order for the inflation backdrop to really accelerate, at least from a domestic basis, you would need wage growth to pick up. And we don't see that. The unemployment rate is still notching a little bit higher. Demand for labor has slowed down. So it doesn't make sense for there to be a big acceleration in inflation. Of course, the question is how tariffs impact the inflation backdrop. And it's important to note that this is a supply shock to the economy, and it would not make sense for the Fed to be notably hawkish as a result, because that would be a recipe for recession. So our base case is once tariffs hit at the end of 2025, that's when the Fed has to pause for a couple of quarters. Our base case is for 3.
Stephanie, as I'm taking a look at a Redfin report out this morning, newly built apartments rising at 1.5%, biggest spike in 18 months. Reason I bring that up, shelter is the stickiest area of the CPI prints that we can continue to see be the largest contributor to inflation right now. So that in mind, what are your anticipations for the housing market as we get into 2025, as that is impacting, of course, the broader read on inflation?
Yeah, I mean, the one thing I would flag is we got some really good news on the shelter inflation components in the CPI last week. So we saw rent and OER, owner's equivalent rent, step down towards 0.2%. When they were running at 0.3 to 0.4. This is a sticky measure of inflation. Base case is will kind of bounce around a little bit between 0.2 and 0.3% for a while, month on month, which is consistent with about 3.5% shelter inflation, different from 5% where we were before. Looking ahead, the housing market should be kind of similar to where we were in 2024. Mortgage rates are probably going to stay pretty elevated, currently running at around 7%. I think that could step down to 6.75, but you need something in the low 6s to really unfreeze the housing market. So we don't expect a big pickup in housing, especially for people to sell their houses and to see a big lockup in terms of existing home inventory. That said, we don't think the housing market will be notably weak next year either. So kind of status quo from that perspective, which given that we've seen some progress on CPI for shelter, that's not such a bad thing.
All right, Stephanie Roth, always great to get your insight. Thanks so much for taking the time.
Thanks for having me.
Coming up next, you got stock futures heading higher into the opening bell on Wall Street. We got the open for you when we come back.
They're taking a look at the opening bell here at the New York Stock Exchange. MFS celebrating 100 years. And you've also got at the Nasdaq net class ringing the opening bell there. Let's take a look at some of the early movement coming out of the gates here. And we are flat but to the upside for the Dow Jones Industrial Average right now, sitting just below 44,000 on the day, but up by about 0.1% to begin things. The Nasdaq holding above 20,000 right now. That's up 0.5%. And the S&P 500, you're seeing that up by about 0.3% right now. I want to take a brief look at some of the 11 S&P 500 sectors. We've got them loaded up here for you on the screen. Energy is pulling up the caboose right now. It's down by about 0.6%, but more gainers than laggards. And the chief gainer right now is XLC, Communication Services. That's up 0.9% to begin today's trading activity. And just briefly, let's take a look at some of those Dow 30 components as well here. And there, we're taking a look at it. We'll put this on an equal so you can get a good view of who's moving higher, who's moving lower. And it looks like we're just about split here on the day, about as split as you can be here. But ultimately, you've got Honeywell leading the pack. We broke that down for you earlier on, exploring and, of course, coming off of the Elliott activist campaign there. What a split of some of its businesses, notably in that aerospace division, would do for the business. That's being priced into shares here on the day. Bringing up the caboose here for the Dow 30, you've got Boeing Aviation. That's down 1.25%. Let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Hey there. I want to go back to the indices. We've had the Nasdaq hitting record highs recently, the S&P 500 pretty close to record highs, just treading water, and then you have the Dow. And the Dow now is finally on an uptrend for the start of the week here, but it has been down 7 straight days. And we've just been seeing this kind of market where there's haves and then you have have-nots, and the have-nots are a lot more numerous. And in that, you can see that in the S&P 500 equal weight index, which is down almost 3% over the last 10 days. Compare that with the S&P 500 regular market cap weighted, and it is in the green. And today is another day of bifurcation. You have the market cap trading to the upside and the equal weighted trading to the downside. So something interesting to continue, but we can chalk that up to just general market rotation in the low volatility month of December. And by the way, December seasonality, that bullish seasonality that we wait for, it begins today in the middle of the month. Not to be confused with the Santa Claus rally, which is the last 5 trading days of the year and the first 2 of the next year. But December bullish seasonality, according to history, tends to happen today. Here's a 10-year T-note yield. It is down 3 basis points. Let's take a look at the 3-month chart, and we can see it was on an uptrend over the last 5 sessions or so, but not today. And 4.5% is the level that we want to keep in mind for the future. Don't want to see too far above that, especially on a rapid basis. Here's the sector action, and we do see the mega cap sectors dominating today. Want to show you real quick what's happened over the last month, and this is not purely since the election, but it has been all about the mega cap sectors: XLY, XLC, XLK, as you can see right there, each up more than about 4%. And we can, excuse me, we can also take a look at futures. We do have gold and silver. They're jumping just a bit after a big 2-day slump, and this is over a month basis. Let's get that down to an intraday, and here we have gold. Let's see if I can find GC, or I'll settle for silver here. Silver up about 15 basis points. Do want to leave you with the Bitcoin action over the weekend. Hit 106,000. That was a record high, and we have kind of backed off that just a little bit. And let's see if we can dial up our cryptocurrency chart here. Well, there we go, 104,500, so a little bit off of the highs, and I'll send it back to you on that.
All right, Jared, thanks so much. Let's get to today's strategy session. We have stocks moving to the upside at the open. We're looking at tech and consumer discretionary as the leaders so far this morning. Joining us now, we want to bring in George See. He's the founder and chairman at Annandale Capital. George, it's great to have you. So we are seeing, once again, tech in the driver's seat here. That has very much been the case over the last several trading days. I guess when you take a look to the upside, how much more room do you see this momentum having?
Well, it really depends on the animal spirits, Shauna. I mean, tech has been in the driver's seat for years and years and years, not just a couple of days. It's really the driving force of the market. And whether it continues into 2025 and beyond really depends on the animal spirits and the speculative nature of the market, so to speak. They're all overvalued. They've all come way too far. And whether they keep going really depends on the cash going into the market and people's willingness to bid up and embrace the greater fool theory, where you try to sell to somebody who'll pay a higher price than you did.
George, is this still a smart buy in your opinion?
Does this instill more buying? I do. I think there's more buying to come in 2025. I don't think this is over yet, but I think it's going to end, and I think it'll end pretty badly when it does. But I don't think we're there yet. I think there's too much euphoria, there's too much optimism, and I think the new administration will be very, very pro-business, and that will help it continue on.
George, as you look out into 2025, and you've recognized already the crowdedness of the Mag 7 trade, where is the non-Mag 7 top pick for you?
Natural gas stocks. I think they're really, really out of favor. They're very low priced, and I think that there's a ton of demand for that commodity. And I think as long as producers show some discipline and don't overproduce, that has a big upsurge in price, where there's a kind of coalescing between the domestic natural gas price and the international natural gas price. And I think there's a lot of upside for those stocks. So that's where I would be focused if I was an investor. But it's a risky trade because domestic producers have shown a proclivity to massively overproduce and drive the commodity price down. So it's a bit risky.
Yeah, George, how do you balance that risk?
I don't know. I've been on the upside of that trade, which has worked out great. I've been on the downside of that trade, so I'm not really sure how you balance that trade. Maybe buy some pipeline stocks, which have some great yields that are much less volatile than the upstream producers. But it's a hard trade to make. So that's my point. Really, is right now in the market, there's no obvious trades. I mean, if you look at small caps, if you look at international stocks, if you look at value stocks and financials, they're all inexpensive, but they're inexpensive for a reason. There's no growth there. So it's really hard to find a place that's obvious right now. And that makes it a real stock picker's market in terms of making good decisions on where you put your money.
Is it also a coin picker's market here, George? I mean, we're hearing from some of the largest firms now recommending to their clients, like BlackRock, saying that, hey, we're now putting in the ears of our clients 2% Bitcoin allocation. What, as you're seeing us move through some of these larger milestones here, psychological as the big number 100,000 may be, holding above that level, that's a key kind of marker for many people who are trying to figure out, does it make sense to get in at this point?
I have no rational basis by which to value Bitcoin. It doesn't make any sense from a financial perspective, but it's worked like crazy. So I have no beef with someone who wants to put some money into Bitcoin. It's worked like crazy. It'll probably continue to work like crazy, but I can't put my pencil to the paper and make sense of it from a financial standpoint. It's much more of a psychological anti-fiat currency, anti-government, anti-inflation trade, but it's worked. So I don't have anything against it.
George C., thanks so much for taking the time here just after the opening bell. Appreciate it.
Thanks for being with me. Appreciate it.
It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at inflation and a risk of a re-acceleration in 2025. Hey, Maddie.
Hey, Brad. So this stood out to me as the story to come out of the weekend here. Apollo's Torsten Slaw calling on the idea that inflation could not only continue to be a risk in 2025, but we could see a re-acceleration of that stickiness in inflation. He points to a lot of charts to back this claim up. One of them I want to show here, core CPI, showing those signs of re-acceleration. Here you're looking at the year-over-year 6-month annualized change and the 3-month, all of which you can see at the end here ticking to the upside. And you can see are well above that Fed 2% inflation target. So that is the key concern heading into next year. Now, not only is that the concern, but Torsten also points out something bad for investors, that this is going to be a repeat of 2022. What did we see then? It was a bad year for stocks, and it was a bad year for the 60-40 portfolio that so many investors know and love as well. So those are going to be the questions I'm going to be asking to guests throughout our programming this week as we head into that all-important Fed meeting. Is this dynamic on inflation going to lead to a changing path forward for the Fed? And what will that do to stocks? We also know Nick Timrose from the Journal this morning out with reporting that this week's summary of economic projections coming from the central bank will potentially be the Fed's chance to really guide the market on this idea that this cut, while it is priced in, may not lead to more cuts to come in the future. The Fed may give itself a little bit more wiggle room moving forward, given some of the stickiness that we have seen, guys, on the path of inflation this year.
All right, Manny, very interesting chart to keep in mind here as we head into a very important week here for the Fed. Well, coming up, Nike earnings are on tap this week. We will dive into what investors are looking for from new CEO Elliott Hill. That's coming up next on Morning Brief. Nike is set to report its fiscal second quarter earnings on Thursday after the market closes. It will be the first since Elliott Hill took over as CEO. We want to bring in Simeon Siegel. He's BMO Capital Markets Managing Director. Simeon, it's great to have you here. A perfect person to talk to about this. So I think the big question for Wall Street is obviously the turnaround that's expected to take place at Nike under Elliott Hill. What the timeline of that is. Do you expect to learn? I guess, what are you most focused on that call? It's going to give us a better indication of what that timeline looks like.
Hey, Shauna, great to see you. I think the big question on Wall Street is why in the world we have so many earnings the week before Christmas, but that's the
another great question.
That is what it is. So I think it's really interesting because here we have one of the largest companies in the world, the largest consumer company that's selling products that is dealing with a huge turnaround. And so the person leading the turnaround is someone that people just don't know, which means there's a lot of uncertainty. And so we know there's a lot of hope on campus. We know the employees love him. But people on our side of the world just haven't really heard of him. And so we get the first time to really talk and start hearing the plan. But I think we have to accept this is going to take some time. And so the trade here is, do you want to believe in hope, or are you going to get held down by numbers? And I think the reality is, for a company like Nike, hope can be powerful. If this was a different company, I think you and I would be having a much more number-intensive conversation right now.
Is this a full reset for Nike as we're looking across what has worked, but what is also fading quickly in favorability among the consumer set right now?
So it feels kind of back to the future-esque. It feels like it shouldn't be it should be a full reset of what happened the last 3-4 years, and it should be a complete kind of redo of what Nike always does. And I think that's what's so interesting. I think it's rare you can see a business that you've watched the last several years make such a loud, incorrect decision, this pivot to direct, this pivot away from partners. The company has all but acknowledged that that was not the right move. And it's not to say throw away direct, but it's to say do not throw away your partners. And so I think what we want to see, and this is why Elliott feels like, and I can't speak from personal experience, I haven't spoken to him yet, but I think that the guy who's been there since an intern, the one who's run up through this entire process of the business, is probably the perfect person to bring the business back to what it needs to be. And so that's why when I think we talk about a reset, I think it's a reset of what we've just come from. But I don't know that this should be revolutionary. I don't know that you and I want to wake up next year and see a dramatically different Nike than the one we know. I think we want to see a business that speaks to its consumer with compelling product and compelling storytelling. And I think that's what Nike has always done really well. And they've always used their retail partners to get there. And so I think if they can tell that story, then I think we're going to look at it very compelling. Into 25, we're going to have a fantastic story as this business regains investor support and then regains the consumer support, because it's going to happen in that order. They're not going to have amazing business. The revenues are not going to start growing before the stock does. The business will always inflect before that brand. The quality of sale will always inflect. So we'll be talking about the stock moving, I think, before we can actually say, okay, here's a great product, here the numbers are moving, and this just looks clean.
So, I mean, there's a lot to be encouraged about as you look ahead maybe to the next several quarters. I'm curious, though, just what your checks are showing you so far this holiday quarter.
Yeah, so it's funny. It was right after I just said they actually are a little bit more positive than we've seen. So I would say after holiday last quarter, the quarter that they're going to report right now, it looked to us that promotions were higher as a percentage, but now it looks like that might be a little bit cleaner. And I think what's important is it looks like Nike has embarked, whenever a brand stretches too far, the first thing they need to do is pull back. They need to work through that excess product. Then they can start rebuilding their brand. While you're working through excess product means the customer is going to get a lot of discounts. And I think that's what they did. But I think what we're seeing right now, and again, it's a few weeks, so it's a little bit early, and we'll find out what they say in 2 days. But I think from what we are seeing, it does look to us like they may have done a nice job clearing through that product. I'm not seeing as much on sale that I saw before, and that would be encouraging. Again, I want the story, the Nike story, I think should be bigger than my checks, because I think at the end of the day, you need to buy into the fact that they're going to be able to sell and dwarf the rest of the competition once they come back. But that said, these little nuances, I think we are seeing green shoots, which are exciting.
And so all of these things considered, what are the top things that you need to hear from Nike to get a sense that even now with Elliott at the helm and looking across the consumer, that is going to be even more stringent about how they are spending unless they see new innovation? What is your assessment, kind of not just going into this call, but the things that you need to hear to be confident that they're on the right path, at least to see the stock inflect prior to it hitting the revenues?
Yeah, it's very fair. So listen, you and I have talked about this a few times in recent quarters, where I do want to throw in the fact that I know the consumer is tight, and I know that We don't have the stimulus-driven excitement that we had during COVID. But the consumer is still spending. And I think there's a misnomer there a little bit that all of a sudden everything's, even on the luxury side, we're hearing businesses like LVMH tell us things are challenging. On the other hand, Prada and Hermes are telling us they're great. And so for every Nike and LV, there's a Prada or a Hoka. They're businesses that are working. And what's interesting and actually encouraging is we're seeing it across the board, across all markets. And so their businesses selling the same thing to the same people, getting different results, which just means the good businesses are winning, the lazier ones, the laggard ones are lagging. And that is what's supposed to happen. So I do want to stress, I do think even with the environment we're in, people are, healthily or not, overspending, and they are making sure they have something under the tree. So now with that said, I think what I would love to hear is I'd love to hear Elliott Hill's strategy. I'd love to hear him say, this is what Nike used to do really well, and here's what we're going to keep, and here's what we're going to throw out that window. I think that path, my opinion is that path is much more of keeping what they did, is saying we are going to re-embrace wholesale. You are going to see us in these partnerships that sold our product and did it very well. But at the same time, we're going to make sure we're doing it in a brand healthy way and we'll get gross margin. So I think the first thing we want to hear is what is that strategy for innovation, but also what is that strategy around marketing? When am I going to get a compelling story? If you and I think about, there's a lot of slogans that Nike is known for, and if I asked you to name one of the last couple of years, you probably wouldn't have one. I think the only one is winning isn't for everyone, which had a little bit of an ironic sense. And so I think that's what we want to see. We just want to think this should, again, I don't think this should be revolutionary. I think if they can come out and say, we're back to being Nike, then I think investors will come back saying, I want back to wanting to own Nike. I think that would be the first step. I think hope will predate the business.
Simeon, thanks so much for taking the time, taking a look at shares of Nike, down 27% year to date. So we will see exactly what the company has to say, and we'll see the stock reaction as well after the earnings. Appreciate you taking the time.
Good to see you guys. Happy holidays.
Thanks. Same to you. All your markets action ahead. Stay tuned. You're watching the Morning Brief.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capsule Gains.
We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. First up, we've got a downgrade for Netflix, but it's not all bad news here. The streaming giant cut by Loop Capital to hold from buy, but the price target going up to $950. Analyst Alan Gould saying that the stock is now approaching fair value. Meantime, Oppenheimer also raising its target on Netflix to $1,065. Analyst Jason Helfstein is revisiting the bull case here thanks to the company's foray into live events.
Plus, Ford shares are under pressure on a downgrade from Jefferies, the bank lowering its rating on the stock to underperform from hold, cutting its price target to $9 a share. Jefferies saying that the automaker is facing broad concerns from inventory overhang to decisions about its European business. Before today's move, shares of Ford were already down about 15%.
And finally, shares of Biogen are searching for some direction after a downgrade here. Stifel lowering the biotech to hold from buy. And part of the reasoning here from the analyst is that the company lacks a clinical catalyst for 2025. Shares right now down by about 0.1% for Biogen here this morning.
All right, well, that does it for our morning brief. But keep right here on Yahoo Finance. Join me and my co-host Madison Mills for the next hour. We've got much more analysis coming up on today's market moves. We're also going to talk about market implications of a second Trump administration, breaking it down by sector. We've got that coming up for you next, right here on Yahoo Finance.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour.
First up, stocks expected to keep up the rally into year-end. How December gains could impact the so-called Santa Claus rally.
Plus, big tech heading to Mar-a-Lago. We bring you special coverage on how the tech and other key sectors could be impacted by the incoming Trump administration.
And Yahoo Finance announces our pick for the company of the year. We'll bring you that name right here on Catalyst.
Let's take a look at the market moves to start the hour. This is sponsored by Tasty Trade. The major averages here just about 30 minutes into the trading day. You're looking at some movement here to the upside. The Dow just holding on to gains. You got the S&P up about 0.3%. The Nasdaq, once again, the outperformer of the group, a continuation of the trade that we saw work last week as we did see narrower breadth play out in the market, a concentration of favoring among investors towards some of those larger cap tech names. That, of course, looks to be carrying through here to today's trading action. You've got the Nasdaq up just about 0.6%. Flipping over to the bond market as we do get closer and closer to the Fed's decision on Wednesday. Now, there is a high expectation that the Fed is going to cut. I believe right around 98% of traders are betting on a 25 basis point cut on Wednesday afternoon. Taking a look, the 10-year yield off just about 1 basis point. Not too much of movement there, but again, just below that 4.4 level. And flipping over to Bitcoin, this is certainly one of the headlines that we're watching in today's trading day. It did reach just above 106,000. We are just shy of those fresh records that were hit. But again, we've seen this euphoria, this excitement, to say the least, surrounding Bitcoin ever since Trump was elected last month on November 5th. Looking ahead, how much this Bitcoin has rallied, about 50% since election. We have certainly seen more and more investors be pretty optimistic, to say the least, about some of that opportunity and what that could look like in crypto here under a second administration. So here you have Bitcoin just above 105,000 right now.
And you've also got that optimism playing out in stocks. Do not bet against a December rally in the S&P 500. That's according to our next guest, who sees a chase in stocks ahead of the so-called Santa Claus rally. The market gains that historically come from the final 5 trading days of December and the first 2 days of January. This year, that's going to be December 24th through Jan 3rd. That is the so-called Santa Claus rally. For more on that and what to expect ahead, we've got Ryan Dietrich, the Chief Market Strategist at the Carson Group. Ryan, great to speak with you. Just want to get some context on this December. We've obviously had one of the best years on record for the broader stock market here. Does that mean that this December is also going to be a record-breaking month?
Yeah, thanks for having me, and happy Monday, everybody. Listen, we know it's been a strong year, right? Come on, all year, we get that. What's really interesting about December, the first half of December historically isn't all that great. It's the second half of December, starting like right now. By the way, today is like Eat Anything Covered in Chocolate Day. So I don't know if that's a coincidence or not when the rally starts, but that sounds like a pretty fun day to me. And you think about it, yes, we're flat-ish on the month, up a tad. Just some things to think about. 9 of the last 10 election years in December, stock market was higher, stock market being the S&P 500. When you're up 20% for the year going into the last month, 9 of the last 10 times, stock market was higher in December. There's more of these, but I think the reality again is we shouldn't be overly surprised that last week was weak. Yes, it's 10 days in a row now, more decliners and advances in the S&P 500, the most in over 20 years. 10 days in a row, value stocks have declined. I mean, that's kind of weak-ish, but we would not stop believing in Santa just yet. We still expect the second half of this year to be, or the second half of this month to be fairly solid.
Why, Ryan?
Yeah, there's a couple things. I think it all starts with the F word as we talk about the Fed, right? The Fed's going to come up. People are talking about the Fed here on Wednesday. They're going to cut, as you just talked about. They're going to cut, yes. Is it going to be a hawkish cut? Is it going to be a dovish cut? I mean, we continue to think that we look at the inflation data. I know everybody's talking about that CPI data being sticky. If you look under, peel back the onion, if you will. There's 2 components that why we have excess inflation now that we did in 2019. It is because of shelter and it's because of auto insurance, both lagging things. Look at everything else out there. CPI is actually lower, okay? So again, there's all these ways you can look at it. We don't think inflation's a problem. We think the Fed hopefully realizes that, and there will be more cuts into next year. And again, and the other reason it is what it is, you do tend to see a chase. I do this for a living, get to talk to a lot of people, manage a lot of money. A lot of people have missed this rally, talked about being overweight bonds. Bonds are up 2% this year. S&P's up 27%. The honest truth, a lot of people manage a lot of money have missed this, and there's still a reason to think they're probably going to want to chase into the end of the year. And that's what you tend to see. Low volume, holidays, everything's out of the way, Fed's out of the way. Probably just an upward bias.
But before we move past the Fed and say that it's out of the way, we do have some new data this morning, those PMI data, and the services looking particularly sticky, the highest level in the survey since October of 2021. Are you seeing anything in the charts that you look at that throws a little bit of cold water on the bullish path forward for the market that's driven by a sure thing bet on the Fed continuing to cut?
Yeah, not on the Fed cutting, I'd say not quite as much. I mean, that's true there, but look at expectations. I mean, one thing Jerome Powell said for years, he wanted to see forward expectations, consumer expectations come back. I mean, those have come back significantly, whichever survey you want to look at. But one thing that we've written about, talked about, U.S. dollar strength. I mean, when the dollar's been strong here, right, we expect the dollar to begin to go lower. But if it doesn't, that can be kind of the thing that upset the apple cart, so they say, because the stronger dollar historically isn't usually a sign of risk off, or it's a sign of risk off, so I should say. Not so much people being optimistic and bullish. So that's one thing we're watching. We're not there yet, but that dollar strength does have us that could upset this bullish thesis that we've had for going on 2 years now.
Right, I think for investors out there trying to figure out just what exactly that bullish thesis looks like between now and year end, obviously only about a couple of weeks from now, but I'm curious, as we do have the Dow coming off of 7 down days in a row, it does look like we might be regaining some momentum here today. Are we getting back to all-time highs, do you think, before the end of the year?
Yeah, we think so. Yes, the Dow's down 7 days in a row. Yes, just on Wednesday last week, the Nasdaq hit 20,000 for the first time ever this year, okay? And I know this is 1,000-point intervals, but the Dow hit 45,000 not that long ago. 8 separate 1,000-point intervals this year, the most ever. I think it's just important to remember how far we've come. A little pullback here, but even in the 7-day sell-off on the Dow, it's not like stocks are down a lot. Stocks are only, the Dow at least, is 2.5% from an all-time high. After a 7-day losing streak, I went back in history, only like 2 other times in history have we seen a 7-day losing streak with the stock market that close to an all-time high. On average, you're down like 25% off the highs on a 7-day losing streak. What's that mean? This is a kind of slow cuts, if you will. There's some positive things out there still. I think it's more just the market kind of catching its breath, honestly, for the end of year Santa Claus rally. One more thing on Santa Claus. People talk about December all the time. Like you started the conversation. It is the last 5 trading days of the year in the first 2. Those 7 days are historically known as the Santa Claus rally. Those 7 days are up almost 80% of the time. No 7-day combos more likely to be higher, up about 1.3% on average, the third best out of all the 7-day combos out there. So again, we're getting closer to that period. And one final thing on this, guys. Last year, Santa Claus didn't come to town. Stocks were down during the Santa Claus rally last year. Now, they were up like 8 years in a row before that, something like that. But again, just if we are by some chance lower, that's not the end of the world. But we would still expect to see Santa come to town this year.
All right, Ryan, we all hope you're right. We're all rooting for that. We'll see how exactly this all plays out. Ryan Dietrich, thanks so much.
Thank you.
For many years, Yahoo Finance has named one Company of the Year, but this year we decided to go a bit bigger with a suite of awards, including Comeback, Surprise, and Product of the Year. We'll be diving into each one this week here on Catalyst, starting with Company of the Year. That's today, and it's Walmart. The man behind all of this, leading the charge, Yahoo Finance's executive editor, Brian Sozzi, joining us here on set. Brian, a huge week ahead, a huge morning here for Yahoo Finance, naming Walmart as the Company of the Year. Enlighten us as to why.
Well, just a small piece of the wider team. Shout out to the Yahoo Finance team for making this all come to life. I'm just a small piece of the wheel, but let's go to a bigger piece of the wheel. From impressive sales and profit growth, outpacing key competitors, and even outpacing the S&P 500 and Dow Jones Industrial Average, this company has become a force to be reckoned with in retail. I got the chance to sit down with Walmart's CEO Doug McMillon to chat about the company's big year and the road ahead. I have told the Yahoo Finance team something has clicked at Walmart past 18 months. Something unlocked, something got unleashed. Like, what happened? Because your sales have accelerated, your profits have accelerated, and I don't see that happening at many of your competitors.
I go back to before the pandemic when I think about that and the work that we did to make some investments. We invested in wages for our associates. We invested in our people, things like education. We invested in lower prices, we invested in e-commerce, we invested in technology, all within a pretty tight period of time. That obviously creates some pressure on the bottom line, and that creates some overhang for how people think about Walmart. But if you get to the pandemic and you look at how behaviors changed, and curbside pickup, for example, grew at a much faster rate, delivery grew at a faster rate, that was work that we had already done before the pandemic that bore fruit during that period of time. And I think it caused a lot of people, customers, our associates, to recognize that we were on the right track. And we just kind of haven't looked back since then.
Every earnings report I've read from Walmart this year, maybe even a little bit last year, you're calling out upper income households, market share gains from upper income households. Why do you think you're gaining their dollars? And where do you think they're coming from?
I think, number one, we made things more convenient for everybody. Everybody wants to save money and everybody wants to save time. But it's a bit of a continuum depending on your income level. And in the recent years, we've changed enough things that make it more convenient to shop at Walmart that we've been able to retain people that make more money.
Why are prices still high for stuff?
Over the period of the pandemic, when supply chains got stretched, a number of things happened. Input costs went up, and so new levels have been reached that in some categories won't go back down. Now, general merchandise, things that are not food, has come back down much faster. In fact, we're right now in the US, we're deflated by about 4%. Fresh food is moving around quickly. We're just talking about eggs. Unfortunately, eggs are high right now. Some of the other categories have come down. Those cycle times are quicker. Dry grocery, consumables, kind of processed food and things like paper goods and cleaning supplies have been more stubborn. And they're much higher than they were 3 or 4 years ago. And we're obviously trying to work with our suppliers to get those prices down.
On the international business, also very, very strong year, really by country. Walmex, the Sam's businesses in China.
Yeah.
What do you attribute that to?
You've followed the company for a long time.
Back to Asda.
You've seen us, yes. Yeah. You've seen us make investments in new areas like Flipkart and PhonePe in India. You've seen us exit some other markets. So one, we're in good businesses. Number two, we have leaders in the markets that are really capable. And then some of the other things we've done, the IP that's flowing across markets now with this strategy that we have, the tech that's flowing, supply chain expertise, the work that people are doing together to make the total greater than the sum of the parts is showing up in our international results.
Do you get concerned that, some of this momentum pulls back if we have a trade war?
We want prices to be low for our customers, and we want flow to go smoothly. So when we interact with governments, all governments, we try to advocate for that consistency. In the case of the U.S., we've had tariffs in place in various forms forever, I suppose, and a batch of tariffs that happened in 2017 that we're used to operating with. So, we're positioned to manage it, but what I worry about is customers experiencing higher prices, and we're going to do everything we can to try and keep them low.
What do you tell government leaders? Say, hey, guys, you push through these tariffs, we have to take up prices a penny or two. It might impact the consumer. Like, how are you communicating the necessity to keep prices low?
Those leaders have to make those choices. I think from our point of view, we encourage them to be strategic and really thoughtful with them and help them understand how the math works. If we are the importer of record on some things and we pay a tariff, we'll eat as much as we can, but some of that is going to flow through and look like inflation to customers because it is inflation to customers. Here in the U.S., about 2/3 of what we sell is grown or made here, which helps a lot. That other third is imported from around the world, produce from Mexico, some of the imported goods that we have in seasonal categories and electronics and toys from China, for example. We have to manage that mix.
Would it be easier to make more things in the U.S.? Is that possible?
It's growing. We work really hard on that, state by state, supplier by supplier, and we're making progress. Our U.S. percentage has been going up. We've established some big goals related to that.
Is this the year that a lot of tech initiatives that you put in place, maybe when I first talked to you in 2017, that they start to unlock? Like, what are the biggest tech initiatives that have changed Walmart?
In my experience, not some sort of breakthrough year. It's just a continuum. It's just been progress, dealing with tech debt, modernizing our architecture, creating more speed on front-end applications. If you look at kind of big picture what's happened in Walmart in recent years from a customer point of view, is you still have low prices, and now you've got access to hundreds of millions of items on Walmart.com. It's not just the store assortment. Walmart's different than it was before, and you get convenience. So recent survey results have shown that customers are giving us about as much credit for convenience as they have price, and that was not the case before.
How do you think Gen AI is going to impact your business? Like, if we're having this conversation 5 years from now, what changes will I notice in the store? Or maybe things I won't notice and they'll just magically show up on your earnings day?
I'm really excited about what's happened already, and it's an energizing experience as leaders to have to learn and apply so quickly. The cycle times as it relates to generative AI are much faster than a lot of the technology, maybe all the technology that I've dealt with in my career. It's going to help us be more anticipatory for customers and members. Search is going to change. The world will look more like personal shopping assistants than it will an old-fashioned search bar with a laundry list of results that you and I then have to work through as a customer. Just saving us time, making it more convenient, helping us solve problems. You know, in the past, if I wanted to throw a party for the college football playoffs, I was typing in soft drinks, chips, dip, whatever. Now I say, I'm throwing a party for the college football games. What do I need to know?
What does that next 10 years look like for Walmart?
Continued growth in the areas that we've already started. We probably launch some other new businesses along the way, and we keep changing everything we can to take all the stuff that people love about shopping and dial it up and invent new things related to discovery or other aspects of shopping that we love doing. And take all the things we don't like and try to get rid of them or diminish them. And technology will do that. Innovation that we as leaders and associates contribute to it will help do that. I think it's as simple as that. We're going to keep trying to make things better for customers.
Yeah, doing this interview, guys, I have to be honest, it was almost an out-of-body experience for me. And I will say that I say that because it's almost like the past 8 years of my life covering Walmart, interacting with Doug, came to life inside of a produce section inside of a Walmart Supercenter in Arkansas. Things that I remember talking to him about 8 years ago, and my first time talking with him, investments in technology that the street didn't like at the time, they're now in the store, and they are helping to drive big sales, big profits for this company. It's helping them to gain market share from a Target. It's helping them to gain market share from an Amazon, all of which explains why this company won Company of the Year award. And a couple quick plugs. We went deeper into the Walmart ecosystem on the Opening Bid podcast. That's now on our homepage. Senior reporter Brooke DePalma just dropped a Q&A interview with the new CEO of Sam's Club. And we have a whole bunch more content coming out all over our platform. Later on today, I think we're diving into their DEI initiatives. So a lot of good stuff coming.
Yeah, and really important context there in terms of just the changes happening at Walmart, Brian. So thank you as always for bringing us your amazing on-the-ground reporting there. And as Sazi mentioned, you can tune into Catalyst this week for the rest of Yahoo Finance's 2024 awards. Those are going to include the comeback of the year, the surprise, and the product of the year as well. Coming up here on Catalyst, Tesla shares on the move to the upside after getting a street-high price target raise. Plus, we're taking a look at what Trump's presidency could mean for different sectors. We're going to start off with chip makers. Stick around for that next right here on Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. It's all done. Yahoo Finance's trending tickers page. First up, let's take a look at Tesla. Shares are on the move to the upside, up just about 2% after Wedbush analyst Dan Ives raised his price target for the automaker to $515 a share. That's a street high. Ives updating his bull case for Tesla to $650 a share, valuing the company at $2.1 trillion. The report citing Tesla's progress on full self-driving. Ives expecting Trump's policies to ease the way for full self-driving adoption. Maddie, he has been very, very vocal time and time again, a number of times on this program, talking about the advantages of a Trump administration, in particular to Tesla, what exactly that is going to do to boost some of that demand going forward, and more so put it in a better light or put it in a better position against some of the rivals. We have certainly seen some of the traditional automakers being forced to make some tough decisions when it comes to some of their EV models and their EV making that strategy going forward. But again, Dan Ives doubling down on what he has said time and time again here at Yahoo Finance, and now with a new street high target.
And that's perfect for Dan Ives to do in this moment because Tesla has been trading above the highest price target call on the street. It's very rare for a stock to do that. So this latest, most bullish call on the stock, resolving that issue for Tesla here. And to pull out a specific quote from him, he says the second Trump admin is going to be a total game changer for the autonomous and AI story for Tesla and Musk over the coming years. So a little bit of a nod to that full self-driving regulation that is expected to come under Trump 2.0. Let's also talk about SoftBank CEO Masayoshi Son reportedly announcing a $100 billion investment into the U.S. That is expected to come out during a visit to Mar-a-Lago today, according to reports from CNBC. Son is also expected to announce SoftBank's intention to create 100,000 jobs in the AI sector as a part of that investment. And this echoes a similar agreement made between Son and Trump back in 2016. That was a $50 billion investment, so paling in comparison, and plans for just 50,000 additional jobs. And that investment, I should mention, was funded in part by Middle Eastern countries. We don't have a lot of clarity as to where the $100 billion investment is coming from. This time around, Masayoshi Son is only valued at about $30 billion on hand today, so it's unclear where the rest of that money is going to come from over the next 4 years here. But just to give some context around that $100 billion number, that's about the size of the entirety of Starbucks, so certainly a lot of money there.
It is a lot of money, and I think it also just points to what exactly, I guess, how big of a boost this could be for the incoming Trump administration. We know Trump time and time again has talked about the improvement in the U.S. economy going forward. That very much is going to be a focal point here in his second administration. Says that he wants to hit the ground running. So an investment of this size, like you accurately pointed out, obviously massive implications just in terms of the number of jobs that would be created, like you just cited there, and what this means more broadly speaking, I think, for Trump's relationship with the tech sector. That's very much in focus when you take a step back and take a look at the long list of CEOs that he has met with or planning to meet with here over the last couple of weeks and looking ahead over the next few weeks. So again, just further doubling down on this potential investment here from SoftBank, just exactly what this means ultimately here. We know that Trump has very much been very encouraging and optimistic when it comes to Son specifically, calling him one of the great men within the industry. So again, furthering those ties, I think is certainly something investors want to keep in mind here as we look ahead to 2025.
Absolutely. Absolutely. And as we do get closer to President-elect Donald Trump taking office, we're going to do a sector spotlight, looking at how potential policies could impact your investments across several industries. We're going to start out with tech, as several executives make the trip to Mar-a-Lago to speak with Trump. We'll unpack the policies that they're hoping to see. One policy that's dominating the conversation is, of course, tariffs. So we'll speak with experts on how U.S.-China relations could impact the chip sector specifically, and the housing outlook for 2025 could all come down to older Americans who supported Trump over Harris 52-47 in the election. That is according to the Associated Press.
Let's start with semiconductors. The Bipartisan CHIPS Act passed by Congress under the Biden administration focused on incentives for domestic chip production. President-elect Trump has called that CHIPS Act, quote, so bad during his interview with Joe Rogan. He's been very critical of the implementation of that. And Trump has approached competition on chips by threatening tariffs on China. Now, amid those threats, Beijing recently launched an antitrust investigation into NVIDIA. Joining us now for the road ahead here for chip makers under the incoming Trump administration, we want to bring in Patrick Moorhead. He's the founder and chief analyst at More Insights and Strategy. We also want to bring in Chris Miller. He's author of Chip War. It's great to have you both. Patrick, let me go to you. When we talk about how critical President-elect Trump has been of the CHIPS Act. He wants to obviously make changes. Lots of questions about what exactly the pathway forward is going to look like here for the industry under Trump. Is it a positive picture or is it a negative one?
I think it's going to be net positive. I mean, Trump doesn't want to be the president that tanked the tech stock market, and he certainly could do that if he puts any weight on the chip stocks that have been a tremendous part of the growth over the last 4 years. And I think for people have to keep in mind that with him, it's all about the art of the deal, going back to the book that he wrote back in the 80s. And I think this is all about a negotiation. I think it's all about getting companies like TSMC and Samsung to create more jobs here in the United States. With all of the advanced semiconductor manufacturing leaving the United States or most of it, Trump's trying to get the best deal to bring it back in. I do not believe he will tank the stock market or major industries to make that happen.
Well, Chris, it's really interesting because we know that the origins of the CHIPS Act came under Trump 1.0, and then he says the way it was enacted was so bad, as we mentioned coming into the segment. So based on your reporting, what do we know about what Trump's 2.0 CHIPS policy could look like his second time in office?
Well, I think that's being defined right now by the president-elect and his incoming administration. They've talked about tariffs as a potential tool. And of course, Trump imposed a whole lot of tariffs during his first term. And I think we should expect that they carry through with at least some of these threats. I think Patrick's right. There will be negotiations. There will be deals cut along the way, but you only get to deals if you build up leverage first. And I think that's exactly why the new Trump team is threatening tariffs, not just on close allies, but also importantly on China. And it's China that bore the brunt of Trump's tariffs in his first term. And I think it's China that's very much in target right now as the Trump team maps out their tariff strategy for the upcoming term.
Patrick, it's very much a wait-and-see mode, although many of these chip companies are acting now or at least talking about maybe that strategy, even looking to hear a little bit more this upcoming earnings season. But I'm curious, in terms of the potential bottlenecks that could be created from a supply chain perspective, is that something that investors should be worried about? Or I guess to what extent or when should they then be more worried about the impact of that?
So first off, I just want to say that I don't think China is going to be the major issue here. I think it's more TSMC, but I'll focus in here on China. I think investors should be looking into every one of their investment plays and seeing if they have a supply chain resilience plan. It's a what if. I will tell you the assemblers of PCs and servers and networking equipment are actively engaged in finding ways to move manufacturing out of China. I think China has a lot of leverage here. There was some discussion earlier about that leverage. I mean, China could maybe slow roll a 30-cent PMIC, power management integrated circuit, to hold up shipments of $100,000 cars here in the United States. They can also play tit for tat like we've seen, like they did earlier with IBM and then with Cisco, and then now we're seeing with Micron. So China holds a lot of the negotiating power here that's related to semiconductors. So we can't forget that. Again, this is all about a negotiation. Trump doesn't want to tank certain markets. And the other thing he doesn't want to do is he got elected based on bringing inflation down. And we all know that tariffs will increase prices of final goods, particularly putting a 60% tariff on goods that come from China. You can imagine everything getting a 60% tariff would absolutely raise inflation here in the United States. And the Trump administration is not going to do that.
You mentioned the tit for tat, Patrick, so I want to stay with you because we know that Beijing has launched this antitrust investigation into NVIDIA for anti-competitive practices. Let's just get to what investors want to know. Is the precious market darling NVIDIA going to be okay regardless of any potential policies to come under Trump 2.0?
Yeah, so all or most of NVIDIA's growth has been in the hyperscaler data center, and pretty much every one of those cards and those platforms have been banned from going to China. There was a wave of tuned down NVIDIA parts that went in there. So NVIDIA has already been reduced in China. I mean, sure, it could go from 10% to 0. I don't see that happening. So net, I don't see a big impact. There is some packaging and assembly that happens in China, that advanced CoWoS and CoWoS 2 packaging. And that's something I just need to do a little bit more research on what they do with it, because what that could do is raise the price of those technologies where NVIDIA cards are made, assembled, or there's packaging done there, which could also be applied to tariffs.
Chris, what about the industry-wide implications or waves from this? When we take a look at what's happening here with NVIDIA, how worried should some of the other larger chip makers like an AMD be, just in terms of what this could potentially signal? It could be coming down the road for them.
I think Patrick's right. NVIDIA is much less exposed than the typical chip maker, with a smaller share of its revenue coming from China. Others have a much, much larger China revenue share. Some companies, it's as high as 50%. And we've seen China take steps not only against NVIDIA, but other US companies too. A cybersecurity investigation threatened against Intel earlier this year, a different investigation against Micron last year. And I think China is signaling it's willing to restrict access to its market as a retaliatory tool against US firms if the Trump administration tries to ramp up pressure.
All right, guys, we got to leave it there. Thank you both so much for joining us with our sector spotlight on chips, Patrick Moorhead and Chris Miller. Thank you. Coming up, we'll have more on our Trump sector spotlight. We'll look at how big tech and how potential policies could impact your investments across industries and sectors. That's next on Catalysts.
Tech titans are courting President-elect Donald Trump for his second term. SoftBank CEO is set to announce a $100 billion investment in the U.S. over the next 4 years during a visit to Trump's home in Mar-a-Lago today. That was first reported by CNBC. For U.S.-based tech leaders, Trump has already met with Mark Zuckerberg, Tim Cook, and Sundar Pichai. Jeff Bezos is slated to meet with Trump later on this week, reportedly. We've also seen tech companies donate to Trump's inaugural fund. You have Meta, Amazon, and OpenAI Sam Altman all making $1 million donations. Here with more, we want to bring in Lauren Feiner, a senior policy reporter at The Verge. Lauren, it's great to have you. We were doing a deep dive into your extensive reporting on this, and I'm curious just what you make of the interest that we have seen from tech CEOs this time around, obviously playing it a little bit differently than what we saw during Trump's first administration, and what investors need to be prepared for just in terms of whether or not we actually will see a significant change this time around?
Yeah, absolutely. I think tech CEOs are taking a very different approach this time around when it comes to the Trump administration. We're seeing a lot less resistance, a lot more, openness to working with Trump. And I think an understanding of how Trump and his team tend to work, having experienced it last time. So, I think we're seeing a recognition from the tech industry that there's a lot on the line in terms of policies and lawsuits and all the rest, and they want to be on the right side of the administration going into things.
And one area of focus is AI. We know from SoftBank's investment news this morning that that $100 billion will potentially go towards creating 100,000 additional jobs related to AI. Elon Musk very focused on AI efforts heading into Trump 2.0. What stands out to you as the biggest potential shift on AI policy heading into the next 4 years?
Yeah, I think, it's largely expected that Trump would roll back the AI executive order under Biden. It's expected we'll see kind of a different approach to just what the priorities are in terms of AI and, what sort of safeguards need to be in place. And, I think that still remains to be seen what that'll actually look like, especially with the involvement of Elon Musk, who has his own interest in AI. So we'll see if he has influence over how the Trump administration decides to approach these policies. But, I think it's definitely going to be a market difference from what we've seen so far.
What has the reaction inside the tech community been to Musk specifically? I mean, we've done so much reporting on it. I know you've been looking closely into it. How positive are they that we are going to see significant change and it's going to come, I guess, relatively quickly? That's the big question.
Yeah, I think Musk's involvement feels like a big wild card. I think we all can see that there's these two big personalities, and we'll see how long that's able to be sustainable. But so far, it seems like Musk has really been able to have a lot of influence in this incoming administration, and I think there's a recognition this time around that things are going to be different, and there's an acceptance of just the way that the Trump administration might be trying to work.
One of the big potential differences is on regulation. What can you tell us about what antitrust is going to look like under Trump 2.0?
Yeah, so far, I think the nominees that we've seen from Trump in antitrust seem to be likely to follow some of the same populist tendencies that we've seen under the Biden administration. It's interesting, I think, in antitrust, it's not always just directly on party lines how things fall down. There's kind of, a more populist tendency versus a more traditional establishment tendencies. That said, I think, the sorts of things that this administration will be thinking about antitrust and its potential uses might be different. The FTC chair that Trump selected, Andrew Ferguson, has talked about, making sure that big tech isn't censoring. So I think we're going to see more of a focus on using antitrust towards some of these other ends potentially.
All right, Lauren, we got to leave it there. Thanks so much for joining us this morning. Coming up, we'll talk about what U.S.-China relations could look like under the incoming administration. That's next right here on Catalysts. U.S.-China relations are top of mind heading into Trump 2.0, as the president-elect has proposed an additional 10% tariff on China, while also threatening levies as high as 60% on all Chinese goods. This all comes as China's economy continues to be under pressure, with an unexpected slowdown in retail sales, adding to the macro backdrop confusion. For more on how Trump policies could impact this relationship, we've got Shahzad Qazi, China Beige Book's International Managing Director. Shahzad, it's great to have you on here. So the Chinese economy is still clearly under pressure. It's clear that these tariffs are coming to some degree. How much power does Beijing have in tariff negotiations given the struggling macro backdrop in APAC?
Yeah, look, I mean, the Chinese economy is certainly weak, not catastrophically so, however, and that's a very important point. I think rather than just looking to negotiate, what Beijing is going to try to do is hit back and retaliate, I think, as hard as they feel that they need to, depending on what the tariffs look like. But I think even more importantly, what they're going to be focused on over 2025 is making sure that the tariffs are being met with as much monetary policy support and I think as much fiscal spending as is needed in order to counteract their impact. And I think a lot of that would really just come down to heavily supporting the industrial economy, the manufacturing economy in China.
Shahzad, what do you think? And we're showing pictures right now of President-elect Trump and Xi Jinping in the past. When you come to how this relationship is likely to play out over the next 4 years, when you talk about the likelihood of tariffs, maybe to the extent of the tariffs that could potentially be implemented, and then you also have President Trump extending the inauguration invite to Xi Jinping, which is pretty substantial in and of itself. What to you does that signal about their relationship between these two world leaders, and what investors should take away from that?
Well, so, they've done this before. We've already seen round one, and round one ended, of course, with a trade deal. And that's what markets are getting very excited about. They are very convinced that there is going to be another deal. But I would caution very, very heavily against that. I think this time around, the Trump team is coming in with a far more aggressive agenda. A lot of the press reporting between there being a lot of daylight between what the incoming Commerce Secretary would like to do versus what the traditional trade folks want to do, I think it's overplaying. There's a lot more similarity. There's a lot more convergence of opinion than anything else. And the Trump team is coming in understanding that the president wants to go hard, and that's what they're there for. They're there to implement policy. This is not like Trump 1, where you've got a bunch of staffers who are going to be fighting constantly trying to convince the president to go in different directions.
But in terms of the reaction function of Beijing, is there sort of a requirement now for Beijing to finally issue some stimulus to consumers given the pending threat of tariffs?
They're not going to, I think, go big on the consumer side at all. It's sort of almost antithetical to their ideological convictions, at least so far. Plus, I think what they want to do is make sure that they're supporting their companies. They want to make sure that they remain a very important dominant power as far as manufacturing is concerned. We hear about new productive forces all the time out of China now. They want to be a major player in high-tech manufacturing. And so the focus of their stimulus policies is going to predominantly be on the industrial side, I believe. And of course, the real takeaway there is, does that exacerbate the very trade problem that's inviting these tariffs to begin with?
Does it, do you think?
I think so. Absolutely. Look, Chinese overcapacity is here to stay. It's not going anywhere. And so if they keep doubling down on this as they have, it's only going to create more and more, I think, problems. And it's not just going to be an America-China story anymore. We've already seen emerging markets taking action. So Chinese overcapacity, I think, is here to stay. And more tariffs and more trade wars across different countries vis-a-vis China, I think that's the future we're looking at.
So then, can the Chinese market, given that, coupled with the fact that we are also seeing some of these econ data, Maddie referenced the retail sales number that was out this morning, obviously very weak and emphasizing some of the challenges facing the country right now. Can the market side of the story when it comes to China, can that still be okay, given all of these challenges?
I think the market might get some positive surprises. Look, if you look at the property market, it's clearly showing some signs of stabilizing at a low level. But those declines that we had gotten so used to, it seems like there's some breathing room finally in place there. These retail sales numbers are not altogether, by the way, that bad. We saw some retail weakness. We saw more services weakness in our November data. But that could turn around as more stimulus comes along the way. There could be incrementally somewhat better numbers, even if they're not magically, better numbers. So I think the market may actually have some positive China stories to pull on next year. And of course, the other big one I should mention is, the improvement in corporate borrowing, which we saw after a very long time. So business confidence actually may not be as dour heading into the end of this year, beginning of next year, as currently the consensus has it.
All right, Shahzad Qazi, always great to get your insight. Thanks so much for taking the time. Coming up, we're going to take a look at the housing market heading into a second Trump administration, the implications of that when we come back.
We're wrapping up our look at how certain sectors could perform under a Trump administration. We want to take a look at the critical issue for voters this election, which included housing affordability. Our next guest says that seniors are the secret key to the market. 60% of all homes in the U.S. owned by people over the age of 60, and that is a 60% increase since the year 2000. Joining us now with her outlook, Meredith Whitney Advisory Group's CEO. Great to have you on here. So obviously seniors are staying in their homes for longer. What reaction function could the policy look like to navigate the challenge that presents for home affordability?
Well, I think what is happening is, so 60% of U.S. homes are owned by seniors. Under 10% of U.S. homes are owned by households under 40. So the affordable housing is occupied by seniors who are aging in place and want to stay in their homes for longer. what that means is that I think a big push in what you're starting to see out of Housing and Urban Development and other federal agencies is a push towards aging in place more safely, more affordably. So I think you're going to see, instead of first mortgages be the big active market, second mortgages and home equity lines of credit, home equity, shared home equity investments, and you're going to see a big upgrade cycle with seniors aging in place. What that means for affordability is I think you're going to see new homeowners continue to struggle and stay renters for longer.
Meredith, when it comes to some of the past predictions that you've given, a 10 to 20% decline that you're expected to see here in home prices, when you come to factor in the Trump era policies or what that could look like when it comes to deregulation, when it comes to tax cuts, how does that then influence the trajectory that we're going to see of home prices and maybe how quickly we could see that drop?
Well, I actually think, whereas I thought home prices would have to decline because seniors would be forced to sell, affordability across the board, particularly for seniors, is difficult because you've had cumulative inflation from higher homeowners insurance, higher property taxes, and you see seniors really struggling. So, in fact, seniors have taken out more debt at a faster rate than any other age cohort, and now they hold 44% of total home equity outstanding. That's up from 19% in 2004. So you see seniors really struggle. So I think that having them be able to tap into their equity is going to be something that the Trump administration really pushes for. And there's 35 trillion of equity, and over half of that is tappable. So I don't think there's a lot that can be done because there aren't a lot of affordable options for seniors. Only 1 in 10 seniors can afford assisted living. So if you're on Medicaid, you can go into nursing homes. But if you're not on Medicaid and almost 80% of, almost 90% of seniors are not on Medicaid, their options are much more limited. Until you get those seniors to move, which they're not doing, the affordability factor then rests just with new home build. And so the administration can focus on that. But I think the easier route for the administration is going to be focused on this incredible amount of money that seniors can tap into that will aid with aging in place.
I do want to pick up on what you just mentioned, though, about new home build. And one of the policies that could be a headwind for that is the crackdown on immigration in particular. How are you thinking about the impact that specific policy could have on the price of homes moving forward?
Well, there's no doubt. And I think that, the cost of building, the cost of land is still incredibly expensive, and the cost of labor is really expensive. And you nailed it. So one of the biggest challenges to home building and renovations is finding the people to do that work. So I think the administration should think very seriously about immigration. And what they want to do is make sure that that immigration is legal, and it seems as if they're focusing on just deporting criminals. Now, that's a small number of immigrants. There are a lot of immigrants that are, the majority of immigrants come here to work hard and create a better life. But the labor is a problem across the board. Labor is also a problem, getting back to seniors, at home care, home health care providers are largely filled by immigrants. And so we have to have a very, very strong immigration policy to encourage immigration, particularly for skilled workers.
Meredith, how critical is that just in terms of if you take a step back and just overall just effectively encouraging new construction and implementing that in a way that is that works and is viable going forward? How critical is that in the piece of all this, and ultimately what that tells us about the timeline, quote unquote, on trying to solve the housing crisis right now?
I think the timeline, this is why I focus on like realistic options. The timeline on new housing build is long, and a lot of that is land-based. And I was just with a delegation from Nebraska looking at manufactured housing, doing a manufactured housing tour. And manufactured housing is cheaper than stick-built housing any day of the week. But the problem is, if you factor the land in, that's where it gets really expensive, let alone the labor that we were talking about. So one government program is to deed over government land, federal land, state land. States own a lot of property that they are not fully using. They shouldn't be asset aggregators. There are going to be options there. So land is a big factor. Labor is also a big factor.
All right, Meredith Whitney, always great to get your insight here, especially taking the time here on Yahoo Finance. Thanks so much for talking to us here this morning. Well, that does it for Catalyst here this morning, but keep it right here on Wealth. It's dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, 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 it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capsule Gains.
We're up for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, navigating your end-of-year trades. We'll talk about stock market performance in December and the reemergence of tech as the leading trade. And the Fed is expected to cut rates by 25 basis points Wednesday. This is the third cut of the cycle potentially, and we'll talk to a strategist about why you should own bonds as the Fed continues to cut. Plus, having trouble thinking of a unique gift for the holidays here? How about the gift of an education? We'll talk to one expert about how you can donate to someone's 529 college savings account. All that and much more during today's show. But first, let's start things as we always do here. Taking a look at some of the market action. 90 minutes into the day, we've got gains across the board for the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite fractional gains here. This is ahead of the Fed's two-day policy meeting this week. Expected to cut rates by 25 basis points is what the anticipation is. Joining me now, we've got Thomas Martin, Globalt Investments Senior Portfolio Manager. Thomas, good to have you here back on the show with us. Where do you see opportunity in the final weeks of the year with this as one of the last major tests here for the market?
Well, thanks for having me on your show, Brad. And yeah, with the Fed cutting, and that's almost a certainty, the thing that is uncertain is what the path is that they're going to set out for 2025. And right now, they're saying they're going to cut 4 times, and we expect in the dot plot that perhaps they'll cut that back to 3. But the market is still more pricing in for just 2 more for the remainder of the year. So if that's the case, that ends up that you're having rates higher for longer, and that's going to create a little bit of volatility. Between now and year end is sort of a crazy time in the market when anything can happen, and with stocks moving in directions that you don't expect or having some outsized moves. For the most part, it's usually a good idea to trade as little as possible, as long as you're positioned for what you think is coming in 2025, and if not, to make those moves in a judicious way. So we still like growth and technology and the sectors that had done well this year, so communication services and technology and consumer discretionary.
And perhaps that starts to get into this next question that I was going to ask, which is where are the positions that investors can feel comfortable with, regardless of the year coming to an end in a few weeks or not?
Well, stocks are up, generally speaking, and the ones that have the great stories are the ones that are up the most, and valuations of those are fairly high. So if you're looking for an entry point, you need to find a company that does have good underlying fundamentals, but that just may be temporarily, or hopefully temporarily, out of favor. So stocks that are down 10, 15 or more percent, but that are still good names in good industries with good products and growing addressable markets.
So all these things in mind, as you're thinking about some of the early catalysts or the drivers for portfolios going into 2025, what's at the top of your docket that you're keeping close tabs on and measuring up against for your own portfolio performance here as you kind of think about the changing of the administration? You also have the anticipation of what the Fed may do in 2025 as well.
Yeah, we're a very earnings-driven shop, and that's really where things start. Is what is generating the company's earnings, and are they growing that, and are they doing better than what is expected by the analysts in the community? So we're looking for those companies that are showing that in their evidence. An example of that would be Broadcom, which had been sort of motoring along a little bit, but then with their most recent report and the outlook for that over the next 3 years was considered to be very positive, and so the stock has really jumped. And that can happen with a number of names that also had been sort of laggards or underperforming. So that's what we're looking for, is to see those companies get that information where the company is showing that they can do it and are guiding higher.
So all this in mind, would love to get some top picks here as you're looking out into 2025.
Yeah, so one of the ones in the technology area is monolithic power, and that one has also had a little bit of a hiccup here, as there is some question as to whether or not one of their parts is going to be as broadly used by NVIDIA as people had thought. And if not, how bad is that? And do they have ways to make it up? We're owners of the stock, and we believe that they will be able to make that up, and that the cuts may not be as bad as feared. And at any rate, the news is already baked in, and so we think that the next piece of news is going to be more of a reaffirming than one that is saying, oh, there's more problems there.
Certainly. There's also two household names that jumped out to me that are high in favorability for you, and one of them is Spotify, of course, a household name there, as we just came off of everybody's Wrapped playlist that just got posted across social media feeds. And then additionally, another household name, Uber. Just break these down for us.
Sure. So we'll start with Spotify, and that is one of those companies that has just done so well and is trading near its all-time highs and has a fairly high valuation. But this is a company that is really still at the beginning stages of its penetration of its market, and the way that they break down their pricing tiers and the audience that they have, they're really able to segment what they do and to price it accordingly. And they still have pricing room left to be able to do that. So it's penetration, it's pricing, it's new ways of hitting the market, and the technology that they have gives them an advantage over other players. So that's why we like Spotify, even though it's continued to perform well. And with regard to Uber, that was a stock that was sort of a tale of two performance measures this year, coming out of the gate very strongly and doing well, and then getting cut significantly this year, really mostly on fears of the automated vehicle and the robo-taxi, and this will put them, at a severe disadvantage or actually out of business altogether. We think that one of the strongest things they have is their software and their technology and their logistics and their hold on the marketplace, and that they will be able to either do deals or otherwise be able to take advantage of the market and be a go-to company rather than one that goes out of business. And that stock is down significantly, so it's a good entry point for Uber.
All right, Thomas, we're going to have to check back in on these picks once we hit the new year. Appreciate it.
Great, thank you.
Certainly. Well, the Magnificent Seven continues to dominate the market, hitting new highs as we close out 2024. Yahoo Finance's Josh Lipton is here now with a closer look at how the big tech stocks could continue to climb here. Josh, what do we know?
That's right, Brad. So investors, we know, looking for places to put their money, and one group that they think continues to look like a real opportunity. The Magnificent Seven are big tech stocks. That's Apple, Alphabet, Amazon, NVIDIA, Meta, Microsoft, and Tesla. Check out the MAGs. That's the ETF that tracks this group. It has been hitting records and now up about 70% in 2024. There are different reasons explaining this move for our tech heavyweights. For one, check out this chart from Piper Sandler's Michael Kantrowitz. What he's showing here is that the relative performance of other 493 companies in the market compared to the Mag 7 is at a new low, and so too importantly are their earnings. Now, another reason, if we think inflation is actually proven to be kind of sticky here and rates are going to be higher for longer, then investors do tend to get more relatively defensive. And one place they can look at are those Magnificent Seven names with their solid balance sheets and tons of cash. Of course, these stocks have also already enjoyed strong runs. We know that. That's why some strategists have recently told Yahoo Finance they are now, in their words, slightly pivoting away from these giants. Yes, they acknowledge these are dominant, strong companies, but in their opinion, valuations now seem kind of stretched, so they're beefing up their positions, they say, in other beaten down names and sectors as we roll into the new year, Brad.
Josh, thanks so much for the breakdown. We're going to be watching the Mag 7 very closely going into 2025 yet again here. Now time for some of today's trending tickers here. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Palo Alto Networks, the stock edging higher after the company completed its 2-for-1 stock split. Now today marks the first day of trading on a split adjusted basis. So for anyone worried why the price is so different, for every share, another was issued. So the stock price looks like it was slashed in half. But in reality, if you own one share, you now have two. Stifel's Nicholas reiterated its buy rating on the stock, but lowered the price target based on the new stock price here. Next up, we're also watching shares of Grindr. They are rising, thanks to a bullish note from Goldman Sachs, the investment bank, initiating coverage on the online dating company with a buy rating and a $20 price target. And finally, let's check in on shares of SoundHound AI, the stock rising on a bullish note from Wedbush's Dan Ives, who raised his price target on the stock to $22 from $10. Ives saying SoundHound is in the early stages of capitalizing on its growth initiatives with enterprise AI demand just starting. Coming up on the other side of this short break, ahead of an expected rate cut on Wednesday, our Fed reporter is going to break down 3 of the biggest moments for the central bank of the year. Stay tuned. Investors are betting on a final rate cut from the Federal Reserve this week. But as 2024 winds down, we're taking a look back at the top moments, keys from the Fed this year that have set the stage for what might come in 2025. Yahoo Finance's Jennifer Schonberger joins us with the details. Hey, Jennifer.
Good morning, Brad. It was a big year for the Federal Reserve. From the inflation roller coaster to the first rate cut in 4 years, here is a look back at 3 of the biggest moments for the central bank this year. The year kicked off with many on Wall Street expecting some 6 rate cuts. But an uptick in inflation in the first quarter caused the Fed to hold interest rates higher for longer than anticipated. Fed Chair Jay Powell said in April it would take longer than expected to gain confidence inflation was coming back down to the central bank's 2% goal.
The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence.
Moment came in August during Chair Powell's annual speech in Jackson Hole when he would finally set the stage for a rate cut. Officials would gain confidence inflation was dropping, while a weaker than expected jobs report in July would cause concern among officials that the labor market was slumping.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability.
Then came September, the moment that markets had been waiting for all year. The Fed made its first rate cut in more than 4 years. A jumbo 50 basis point rate cut prompting some to worry out of the gate that the Fed had gone too aggressively, just as the fight for inflation seemed like it was nearing an end.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
That brings us to now, where inflation looks like it may be stalling this fall, prompting many on Wall Street to scale back their expectations for the number of rate cuts in 2025. Brad?
All right, thanks so much, Jennifer. A ton to look back at this year and a lot that could signal what may take place next year. Appreciate it. With that 25 basis point rate cut expected later this week, it's a good time to consider bringing your cash investments off the sidelines, perhaps. Here with the top reasons he thinks fixed income is a good place for investors in 2025, we've got Dominic Papalardo, who is the Morningstar Chief Multi-Asset Strategist. Dominic, thanks so much for taking the time here today. So why consider owning bonds as interest rates come down?
Yeah, thanks for having me, Brad. A few reasons. The most obvious one is there's no longer a yield give up to move out into longer maturities. For much of 2022 and 2023, the curve was inverted, meaning short yields were higher than long-term yields. That's sort of normalized now, and the curve is pretty much flat. So cash rates are around 4.3%, and really any maturity along the yield curve is in the 4.2 to 4.4% range. So there's really no cost to making that trade today.
You know, as we think back to last week, U.S. Treasury yields rose to the highest level since late November, as I'm reading through a note from UBS in my inbox here, even though markets remain convinced that the Fed will cut interest rates further when the FOMC meets this week. How should that be priced into or play into investors' strategy here as they think about this specific asset?
Yeah, Brad, we would agree that more rate cuts are likely to come, particularly through the first half of 2025. And what those rate cuts represent is the opportunity for those longer maturity bonds to actually show price appreciation. So whereas cash can only generate total return through a function of income, longer maturity bonds could produce total return from income as well as price appreciation, which should occur as rate cuts are realized. And additionally,
Sorry, go ahead.
I was just going to say also those cash rates will also decline as rates are coming down. So even that 4.3% cash yield that's available today will dissipate rather quickly as further rate cuts come down the line.
How can investors identify quality bonds and kind of pair that with the expected returns?
Yeah, if an investor is focused on quality, we'd be proponents of adding to U.S. Treasuries. Obviously, they're relatively risk-free as they're backed by the U.S. government. And the yields there are appealing on a real yield basis, meaning that the actual yield of those bonds, even after the current inflation rate of about 2.7%, still generates a positive return for investors. And certainly there's more volatile options in the marketplace away from those high-quality bonds that we could talk about. But if an investor is risk averse, we would say U.S. Treasuries are the way to go.
And so how would you then identify some of the emerging markets as well?
Yeah, we like emerging markets more than we like U.S. corporate credit. Some of the emerging market debts, when you look through that valuation lens of real yields, Brazil, for example, has 5-year bonds yielding over 14%. Mexican bonds are yielding around 10%, and they both have inflation rates around the mid 4% range. So very attractive real yields. Again, those countries will be more volatile as they're rated below investment grade. But for investors that can accept that risk, there's definitely some upside there. When you compare that back to, let's say, high yield corporate bonds in the US that are also below investment grade, their valuation metrics when using credit spreads or the additional spread over treasuries is very, very low. It's in about the 5th percentile of history, meaning that additional compensation for the credit risk has only been lower 5% of the time over history.
Where do you think the real mix and the sweet spot for the mix of a portfolio holding fixed income is right now, especially as you've got some of the largest institutions now initiating their own, not coverage all out, but their own recommendations on how much Bitcoin and cryptocurrency versus fixed income versus equities should be held?
Yeah, Brad, we really still like the intermediate range of high quality bonds. When you think about how that fits into a diversified portfolio, fixed income today, because of the yield rise we saw in 2022, is able to offer some hedging protection. So if we get an environment where, let's say, equities become volatile and see prices fall, we would expect that high quality fixed income allocation to rally and really offset the losses being experienced from the equity side in some ways. That didn't exist. That protection wasn't available when rates were near 0%. But now that we're back to the mid 4s, there's room for those rates to fall and provide that ballast to a portfolio. And we think that's a prudent choice to make. And we would remind investors to treat fixed income as something that could be conservative and helpful and not just chase those high yields that we talked about in emerging markets. That may be an area where investors could dabble or add some plus exposure, but that shouldn't be the core fixed income allocation within a diversified portfolio.
Dominic, really great insight and analysis. Thanks so much for taking the time.
Thanks for having me, Brad.
Certainly. Dreaming of buying a home in 2025? Realtor.com and Redfin estimate that home prices will rise more than 3.5% in 2025, with rates remaining above 6%. Here with more on the 2025 housing outlook is Yahoo Finance's own Claire Boston. Hey, Claire, so what can potential home buyers expect here?
Yeah, Brad, you look at those numbers, we're going to see rising rates and then also, still a relatively high mortgage rate there. And so we will have to see what that means. Probably it's going to be a little bit easier to buy a home next year, though. And the reason for that is inventory. A lot of people I talk to are expecting inventory to improve next year. Some of that is going to be that as we stay in this higher rate environment, buyers are going to get used to that. And they're going to decide, OK, it's my time. I'm just going to start looking for homes. Or, sellers will also come in and say, I'm going to sell my home. And that might make it a little bit easier for some entry-level first-time home buyers to get into the market here.
Claire, there's a strategy that you're tracking as well that could impact affordability. Tell us about this.
Yes, so I have been looking a lot at the new housing market. And so this is an area where we are seeing a little bit more inventory than that existing home space. And so one thing that builders are having to do to move some of these homes is offer buy downs, mortgage rate buy downs specifically. So the prevailing rate right now is close to 7%, but builders will often offer incentives, letting people get mortgages for more like 5%. So that can be a really key way to help affordability in this market right now.
Claire, thanks so much. Appreciate it. A lot to track within the housing market going into next year. Well, TikTok Shop is quickly becoming the next big name in e-commerce. It's now a more popular online retailer than Shein and Sephora in the U.S. That's according to a 2025 Consumer Trends report by Coefficient Capital. The report also finding that 45% of surveyed Americans have bought something on TikTok. Joining me now is Amber Venz-Box. She is the co-founder and president of LTK, a company that helps brands and lifestyle creators monetize the digital space. Amber, great to have you here with us. You shared 5 creator economy industry themes to watch heading into 2025. And I want to start with the first one. Creators are expected to have a growing influence in several sectors here. What are those sectors and what's the expectation?
Well, creators are now influential across many different categories, not just fashion and beauty, but across grocery, home, athletics. This has been a tremendous year for what we call creator commerce. That's where a creator who doesn't hold inventory but is recommending products to their audience is making an impact on retail sales. This year, actually, Adobe Analytics showed that creators drove 20% of holiday shopping on Cyber Monday. So when you reference, the growth in TikTok Shop and how it's actually outpaced Sephora, from an LTK perspective, LTK has outpaced Sephora as well from a digital sales perspective. We now see that this year versus last year, 56% more people now report that they are actively shopping from creators. So this is something that's not going away, and it's absolutely cross-category.
How do you expect artificial intelligence to advance the creator economy?
We're really focused on making sure that it's driving efficiencies. So from a creator perspective, you have a limited amount of time every day and you are the talent. And so we're helping them to create content faster, tag products faster, to make sure that they're tagging the right products that are going to drive the highest yield for them as a creator. We are taking all the CRM responsibilities off of their plate. So you think about the newsletters they used to create, or if they've been able to send a push notification or some sort of in-app notification, we're doing all of that for them today through our LTK Copilot. That's a full automation. We also have tools that are truly more of like an assistant level work, making recommendations throughout their workflow so they can get to publishing faster and creating that next piece of content.
You also expect creators to become master marketers. Explain what you mean by that, because I had to go to school to get a degree for it, but it seems like it's something that you can pick up or at least get some mastery level with some hands-on knowledge.
Well, LTK creators are a retailer's tech-enabled power partner. So their, core expertise is really building that community and building trust with that community and then driving outsized returns for retailers. But many have a profile like myself where I'm more of a creator than a technologist. And so for the very first time in a creator's history, they've actually had a platform where they can create and distribute that content. And then now the platform is doing the work for them that helps them to retain, nurture, and grow that community with all of the best marketing tools built in. So you can think about your retailers are built on a tech stack. Sometimes there's hundreds of integrations, licensed products that are allowing them to really track their customer, try and convert that sale, to reach them in the places where that customer lives. We've built that all into the LTK platform for our creators. And so they're much like a retailer today in that we're able to capture the intent. We know what their customers are clicking on or looking at, and we're able to retarget them based on the products that they say that they love or the content that they love. And that is what is driving these huge returns for our retailers. Creators now are really one of the highest ROI channels when you compare them versus search or social or out of home. And a big piece of that is that they're now built their business on a tech stack that is built to convert for their retail partners.
As we think about the current shopping landscape and holiday sales right now, I mean, you've got some depth of data over at LTK for sure. How are sales measuring up against what was anticipated coming into the season, especially within creators and how they are engaging with buyers and sellers?
Right. Well, creators made the biggest impact on holiday shopping this year that we have ever seen. The Adobe Analytics information showed that they drove 20% of holiday shopping on Cyber Monday alone. On the creator side, they were really excited about this season. We created a whole new suite of tools for them around gift guides. They created 2 times as many gift guides this year versus last year. And what's interesting when you look at then what happened on the consumer side, consumers purchased 18% more per click this year from LTK creators. They were buying over $230 every second in November on the LTK platform. This is really part of a larger cultural shift that we're seeing where customers really want a guide to the internet. When everything is available to purchase online, they need someone that they can trust, and they know that the creator is really aligned with giving them products that they'll love, so they come back to that creator and kind of become a customer of theirs. On LTK, customers will purchase $1 billion more this year from creators versus last year. This is something we only see continuing to grow. Goldman says that this market will double in the next 3 years to hit $500 billion.
Really fascinating. Amber Ven's box. Thanks so much for taking the time here with us today. Got to check back in the future. Coming up, everyone, we've got your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you do not want to miss. Stay tuned.
We are 2 hours into the trading day. It is time for Yahoo Finance's Market Minute. Stocks are mostly higher as investors look ahead to the Federal Reserve's policy meeting starting on Tuesday. Here are 3 trending headlines we are watching today. Shares of MicroStrategy rising alongside Bitcoin. MicroStrategy owns 2% of the world's Bitcoin supply and is set to join the Nasdaq 100 index. Ford Motor is in reverse, declining after analysts from Jefferies downgraded the stock on concerns about earnings pressure and inventory. And Supermicro Computer facing the heat again. The stock falling on a Bloomberg report. The company has hired investment bank Evercore ISI to raise equity and debt capital, and it comes amid growing concerns the firm could be delisted from the Nasdaq. That is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
You're looking at live video of President-elect Trump at Mar-a-Lago. Moments ago, Trump, alongside SoftBank Group CEO Masayoshi Son, confirmed the company's $100 billion investment in U.S. projects over the next 4 years, with a goal of creating 100,000 new jobs.
SoftBank will be investing $100 billion in America, creating 100,000 American jobs at a minimum. This historic investment is a monumental demonstration of confidence in America's future, and it will help ensure that artificial intelligence, emerging technologies, and other industries of tomorrow are built, created, and grown right here in the USA.
I'm now excited to commit this $100 billion and 100,000 jobs into the United States. This is double of last time, as President Trump said. Because I say, oh, President Trump is a double down president. I'm going to have to double down.
Switching gears, the International Air Transportation Association expects a record 5.2 billion air travelers in 2025. It's an increase of almost 7% from 2024. Joining me now with more, we've got Yahoo Finance's own Carrie Hannon. Carrie, what are the biggest travel trends that we're anticipating for 2025?
Yeah, Brad. Well, pull out your passport, because what we're seeing is that international travel is going to be way up next year. I mean, Americans are looking to hit the road, a lot of international spots. But the big trends, and the folks at Expedia kind of help me out with this, that they're seeing are, people are going to do these detours, right? They're going to go, hey, I'm going to go to Paris, but I'm also going to go to Reims, so they're going to pick another city within the country that's, not right, not adjacent to it, but get 2 for 1 sort of thing. The other thing they're doing, and I absolutely love this one, it's called JOMO, right? The joy of missing out. Now, that's sort of the opposite of what we've heard in recent years. But frankly, people are saying, I just want to rent a house and go someplace beautiful with my friends or family and do puzzles. I want to do absolutely nothing. So that's a big trend, I think, because the world's gotten so hectic. It's kind of like, whoa, stop the presses. And the other big trend is, and Taylor Swift got this going, with her Eras tour, that people are saying, okay, cool, there's this concert I want to go to, and I can probably get my concert tickets a little bit cheaper if my favorite band is playing in a European city or an international city someplace, which is often the case. And so they plan a trip around going to a concert or going to a sporting event. And this is, a trend that's been starting to grow. And obviously, as I said, Taylor Swift kickstarted it, but it's going to continue into 2025. And so is this whole idea of people are planning trips around, what they see on their streamers, like White Lotus is filming in Thailand. So people are looking to go to Thailand, or Paddington Bear, that wonderful bear, is going to Peru this year. So there'll probably be an uptick in people going to Peru. So I think there's some fun trends out there. And the bottom line is people are planning to travel, and they're planning on traveling and spending more.
All right, I'm already looking at some Earth, Wind, and Fire dates that might have me traveling next year here. Carrie, while we have you, how can travelers get their hands on some deals next year?
Yeah, Brad, it's usually good, like post-holiday. So if you're planning a last-minute trip, right here, January, February is often a good time before spring breakers. The shoulder seasons are usually good. But I love the idea of price trackers. And, the Google Flights has a good one. Kayak has one. Hopper. And if you know where you want to go, you pick your dates and so forth, and really look at these flights and get dinged when the prices drop. And so that's a real help in looking, and again, you don't want to book too far in advance, usually no more than a month, because you're going to end up spending more if you book too soon. So don't get too excited.
Carrie, thanks so much. Breaking down all the trends we're going to be tracking going into 2025, and we might be part of making those trends happen ourselves. Thanks so much.
Thanks, Brad.
Well, in 2025, the oldest members of Gen X will be turning 60, bringing them one step closer to retirement. And it will look a little different than it did for previous generations. Here with this 2025 retirement outlook, we've got Nick Nafusi, BlackRock Global Head of Retirement Solutions and Head of LifePath Multi-Asset Strategies and Solutions. Nick, great to see you here today. So first and foremost, just talk to us about what we're anticipating as the oldest members of Gen X are going to be hitting 60 here, it sounds like, and that's going to really put the retirement planning in full, and I hope they've already planned, but it's going to be putting it in full motion at this juncture?
Brad, it's good to see you again. Thank you for having me. So what's happening is, as you said, this generation is hitting the age of 60 now in 2025. And we find them as squarely within what we describe as the retirement window. The retirement window is this age between about 55 and about the age of 70, where lots of decisions have to be made. We often think about retirement as a point in time like graduation. In reality, it happens over time. And what we find unique about the Gen X is they really came into the workforce in the late 80s, early 90s. This is after we saw the peak pension plans. So most of these people never had access to a pension plan, but before the early 2000s when we saw the professionalization of the 401k plan. So we find Gen X a bit more stressed than we found other generations in this period.
So Nick, you actually have 5 factors that impact the retirement window everyone should consider. Break those down for us.
So the 5 factors that we think about your own health. A lot of people don't realize this, that one of the biggest reasons why people don't work past the age of 65 is because of their own health. Second one is family considerations, and I think this one will ring true to a lot of the people in this broadcast. Many Gen Xers are in what we call the sandwich phase, where they're taking care of their children, but they're also taking care of parents. So there's family considerations as well, maybe even a sick spouse. Third one is the ability to keep working. Oftentimes we see downsizings, and those downsizings could impact individuals, and we found it harder for some of these people to get jobs again. The fourth one is Social Security. When do they want to claim Social Security? This is all part of the retirement window. And the last one is really around the financial portfolios that they invest in. Are they balancing the amount of growth assets with the amount of safety assets in this time period? Because remember, even somebody at 65 years old has an average life expectancy in America of over 20 years.
Wow. Okay. So all these things considered, how have we seen the mix of that retirement portfolio and the holdings within that portfolio shift over years, especially as pertaining to Gen X now?
So the shift has been, for the most part, the same across generations. When we're young, we want to start off with a higher growth portfolio. And then as we get closer to retirement, we want to put in more certainty into the portfolio. And that word certainty, I think, is really important. What we tried to build at BlackRock are portfolios with more certainty in this uncertain time. So we've launched products like LifePath Paycheck. The idea of LifePath Paycheck is we want to make income the new outcome of retirement investing, where what we've done in the last 20 or 30 years is moving people away from pension plans into 401k plans. The 401k plans have done a great job at accumulating wealth. What we now need to do is look at this retirement window and figure out how to provide more income certainty well into retirement.
We know that BlackRock is in the early innings of even recommending how much Bitcoin people should be holding as well. How does that potentially even transition through into the retirement thesis?
My biggest objective is getting people to save more money going into retirement. So whether we choose Bitcoin or not Bitcoin, what we want to focus on is getting people to and through this retirement window. I think most of the individuals, what they're seeking our help for is how do we spend in retirement? So Bitcoin is an interesting thing for us to consider as part of a broader asset allocation. Trying to help people spend is where we spend most of our time.
Nick, thanks so much for taking the time here with us today. We're going to be tracking very closely to see how many of the Gen Xers are retirement ready, and perhaps some of us millennials can learn from them too a little bit here. Appreciate it.
Thank you for having me.
Certainly. Everyone, let's get a quick check in on the markets here. I'll take a look at the Dow Jones Industrial Average first here, flat just barely to the upside right now, sitting at 1/100% in gains right now. The Nasdaq Composite, you're seeing that higher though by about 0.8%, so some fractional move higher there. You've also got a fractional move higher for the S&P 500, up by about 0.3%. And then additionally, let's take a quick look at some of that sector activity here as we're just a little bit over 2 hours into today's trading activity. There you're taking a look at the 11 S&P 500 sectors here, largely more green than red here. Energy pulling up the caboose. It's down by about 1.4%, but consumer discretionary leading the pack right now. That sector's up by about 1.2%. You've also got gains in communication services and real estate leading the charge. And then taking a look at the Nasdaq 100 here on the day, you're going to see some changes come through from that in the near term. You're also taking a look at mostly gains here, it seems. I'll try to even this vision and this picture out for you, pulling up the caboose there, you've got super microcomputer that's down by about 7.6%. That, of course, is going to be coming out of the Nasdaq 100. And then also taking a look at our leader here today. Oh yeah, that's Broadcom. That's up by about 7%. And just lastly here, let's take a look at your crypto. Bitcoin right now, it's up by about 3.5% right now. 106,000 is where we're lingering, and that, of course, is as we're continuing to track some new highs for the currency here. It seems like we've now taken out the previous high, and we're holding on to that 106,000 level as of this juncture right now intraday. Of course, though, Bitcoin markets don't close. Looking for a gift for the kids in your life this holiday season? What about an investment in their future? I talked to an expert about the investing in 529 account gift that could be a remedy. That's next on Wealth. A programming note. In this week's episode of Financial Freestyle with Ross Mack, Deputy Undersecretary of Commerce for Minority Business Development, Eric Morissette, shares why every minority-owned business should visit their local minority business center. Take a listen.
If you have an idea to create a business, we have business centers probably in your area. Their entire job is to help you grow and scale your business. Find the capital that you need, find the resources that you need, but every business is different. So it's not the case that like, oh, clearly I'm gonna go to this place and get this amount of money. Maybe your business is not eligible for that amount of money. But our business centers, which are graded against their ability to help you as an entrepreneur get access to capital, contracts, and grow your network, their entire job is to evaluate your business and help you get that capital. So the first step in my mind is always connect with the business center of ours. They are free. Their entire job is to help you get those contracts, get those grants, grow your network.
New episodes of Financial Freestyle air Mondays at 12 p.m. Eastern Time. You can catch them on Yahoo Finance or wherever you get your podcasts. Well, a recent Fidelity study found the majority of parents would welcome a unique gift this holiday season, the gift of education. Here to explain more, we've got Corey Latham, Fidelity's Director of 529 College Savings. Corey, great to have you on the program with us. So tell us what this Fidelity study found first.
Yeah, thanks so much for having me here today. So we recently did our Fidelity Investments 2024 college gifting study. And what we found out is that 74% of parents would welcome a contribution to their college savings account as opposed to a traditional gift, and that in fact 62% would even prefer it. You know, looking back at their own experiences, nearly 7 in 10 parents say that they would have welcomed a contribution to their college savings as opposed to a traditional gift. And what we found is there's some generational differences as well. You know, especially around the holidays, that sandwich generation, those that are both caring for a child as well as an aging loved one as well, they're the highest likelihood who would want to have a contribution to a college savings account as opposed to a traditional gift.
Okay, so what are the basics, the need to knows of a 529 account? Who can open one and can anyone gift one?
Yeah, so a 529 account, it's a tax advantage savings account that can be utilized to pay for qualified education expenses. The benefit in it is that any earnings in the account grow federally tax-free. And as long as they are utilized for what's considered a qualified education expense, withdrawals in that account will be federally income tax-free. You ask who can open it. I think typically you'll see it as parents will be opening it for their children, but anyone can do it. A parent, an aunt, an uncle, a grandparent, anybody who really wants to take on that responsibility of helping, you know, with the education journey for that individual, it can really be opened by anyone.
Okay, and so how do you actually open one? What are the steps?
Yeah, so, you know, I can speak for us here at Fidelity Investments. What you would do is you can do that really online is the most typical way where you would do it. You would just need to have all the applicable information, but for the most part, you go right online and open one up. And then as you're thinking about opening one up, we always encourage folks to look at their state sponsored. So you'd always want to look at the state in which you're in to see if there are any benefits within that state, such as like a state tax deduction or something along those lines. You'd want to make sure that you're considering that when opening up a 529, but it's usually just as easy as having your information, going online and opening it up that way.
Any tips, Corey, for people looking to donate?
Yeah, so it can be a little awkward asking for a gift, but I do think that around this time of year, it can be stressful for parents when it comes to gift giving. So hopefully this might take a little bit of the guesswork out of it. Best ways you can do it is, you know, hopefully people know that you have a 529 account opened up. And if you do, tell them that a gift to that account is something that you can utilize. I can speak for us here at Fidelity. We have a gifting dashboard, and what you can do is you can share that link with individuals who would potentially want to contribute to those accounts, and they can directly contribute to it straight from there. You know, it's something that's going to benefit the child later in life, but it's also really going to help benefit them now as well. One of the most important things when it comes to saving for higher education and qualified education expenses is planning. You know, we recently did our college savings indicator study at Fidelity earlier in the year, and we found out that the number one saving priority for parents is education. And one of the best ways to get there is planning. So the money that you're putting into it now helps you as you're kind of building out that plan, understanding what you're going to be able to contribute to those future education expenses.
Yeah, I remember seeing that early in the year as well. And, you know, that kind of brings the thought back to just preparedness. How prepared do families, do households feel, and parents feel, and students as well, as they're getting ready to take on some of the costs of college?
Yeah, I think everyone's a little bit different. I think there's obviously people that are in different stages for it. I think you can always be more prepared. And that's why you want to take advantage of things that are out there, such as calculators and tools, and in ways that you can do that. And that's why gifting is such an important part of it. You know, we mentioned that it's a little bit awkward to ask right now, but the best way to be able to plan for it is understand what you have now. And you always want to try to have getting in as early as you can. So the longer time you have to have that investment, the longer term you have for that potential growth that you could get. So that's why asking for gifts at early stages in the child's life are going to help you kind of gain advantage of those longer term benefits.
Corey, love this tip, love this advice, love the potential gift that we could see some giving this holiday season as well.
Yeah, of course.
Thanks so much for taking the time.
Thank you for having me.
Absolutely. Hey everyone, let's do a final check of the markets here as we approach noon Eastern time. We're taking a look at the Dow, flat but to the upside. S&P 500 up 0.4%. The Nasdaq is up now by about 0.9%. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination. That comes up at 3 p.m. Eastern time with Julie Hyman and Josh Lipton. They'll count you down to and through the market close.